Fed meeting. It is Tuesday, December 17th, 2024. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan, cavorting, single, in Milan. Here for the next hour as we get ready to wrap up this trading day. Futures close at the top of the hour. If you're on the platform, join us on YouTube to tell us what you're trading. If you're on the platform, or rather if you're on YouTube, come over to the platform or to tastylive.com to see what we're all about. Gentlemen, it was the night before the December FOMC meeting, and it was pretty quiet in the house. Bonds are relatively unchanged. Stocks take a small step backwards after moving lower earlier in the day. Gold and silver turn those 1% losses into minor, about 0.3% to the downside. Energy cools off, and FX, what a mess, Ilya. The commodity currencies not showing anything good at all. But we're now in the pre-FOMC drift. The markets tend to just get all quiet of sorts between now and 2 p.m. Eastern on Wednesday. Of course, we'll be covering that at least into it ahead of time on Futures Power Hour. But Ilya, let's just start off here. I know that you were putting together a FOMC preview for the website today, and I'm sure the written word is just as good as the spoken word. So tell us, what will the Fed be doing tomorrow? And given the market pricing right now, what's the possibility of a big impact?
The possibility of the impact is probably coming not from what the Fed will do, but rather what they will signal they will do after this meeting. That there is going to be a cut at this meeting is at this point a foregone conclusion. If you look at the pricing in the markets, and this shouldn't surprise anybody, it's been this way for ages now, there's about a 95% chance being priced into Fed funds futures that we get another 25 basis point cut, thereby completing the as promised schedule that the Fed gave us in September. And really, it wasn't a stretch to envision it. In September, the Fed said, we're going to do 100 basis points in cuts in 2024. Here's half of that up front, and there's 2 meetings left for the rest of the year. Where are we going next? Look here. That's a paraphrasing of what Powell said immediately at the press conference after that meeting. So the promise has been all but certainly fulfilled here. November gave us the 3rd cut. We get the 4th one tomorrow. That's it. The real question is what happens next. And from the market's perspective, they thought back in September when the Fed started, what happens next is 130 basis points in cuts, or 5 cuts next year. They have, over the course of the subsequent 2 months, gone to barely 2. For the Fed, that would mean coming down from the 100 basis points they promised for next year to like 1 or 2. But everything we've heard from the Fed is they're looking through economic data volatility. They don't want to overreact. They don't want to overguide, and they don't want to be on dovish autopilot. We've heard that. But in the same exact breath, we don't want to overreact. We don't want to overextrapolate. So is the Fed going to cut their forecast in half? The risk seems that the answer is no. And that what they'll do is they'll do something more modest and come from 4 to like 3. And if that's what they do, then the market's offsides. That's the volatility risk.
Dylan, does the Fed cut tomorrow matter?
You know, I guess what could the Fed possibly say tomorrow that would move asset prices in any direction?
That's it. They would have to take their SEP and say, we are projecting that next year rates will come down by 3 cuts worth, not 4. Whereas the markets have basically said, you're lucky to get 2. That would mean that the markets have spent the past 2-3 weeks returning to mid-November levels, which is to say sharp dollar rally from mid-September to mid-November.
So you're saying the market's on 2 cuts right now?
The market is on barely 2. It's on 49, 48.
And you're saying the Fed is on 4?
The Fed's on 4. The Fed's on 4. So Well, I mean, take a look at the forecast here. In September, they said that rates will be 4.4 this
let's say
year
the Fed
and
goes to
3.4
3.
next year. That's
So that's
100
Fed,
basis
but
points.
let's say the Fed goes to 3, which would be sort of the obvious thing.
They go to 3. If they don't
What does
go
that do to
2,
asset prices?
if they don't go to 2, then the market has valued bonds way too cheap, yields way too high, the dollar way too strong, and maybe stocks take a leg lower, but that's less clear because the stocks have had a complicated relationship with what the Fed is doing here. It depends why the Fed is cutting or not cutting. My sense is that if the market is, as it is currently, sitting within a hair of record highs, the upshot is money that's not as cheap is net not as good. And so you get a little wiggle lower. And the risk of that you see in markets today. The pre-positioning is weaker equities across the board.
Weaker equities, bonds, though, they do ultimately rally, and particularly the long end tries to stick its head above water by the end of the session. Ultras are up by 0.3%. Long bonds, 0.05% higher. Notes down by 0.04, but off the lows. I find it really interesting that you're seeing the last few days, really like the past 2 weeks, the situation play out where as rate cut odds for this December have ticked up, we've started to see that the market's saying, well, then you're going to have more inflation, Federal Reserve, because you're cutting into an economy that doesn't necessarily need it right now. Mm-hmm. And it's like the environment that we saw play out after September when the Fed gave us that 50 basis point cut and yields started to move to the upside. So when I think about tomorrow's Federal Reserve meeting and what's happening with the bond market, today we had stronger than expected GDP data, retail sales figures. And if we have stronger consumption data, it would behoove the Fed to do what? Do less.
Yeah.
Do less. And if they're going to do less, what does that mean? Well, it means they're going to cut less. It means that the risk of reflation, of higher inflation, of higher growth is diminished. And so bonds actually turn, the growth sensitive, inflation sensitive part of the curve turns by the end of the session in a really important area, mind you, before we go back to the forecast. You could see in ZN right near lows that we carved out throughout November. In ZB, similar situation, right around the lows that are carved out in November. So clearly a place for a pause right now. But decomposing the FOMC projections for tomorrow, do we think that they're going to change the 2025 forecasts? I don't really think they're going to change the GDP forecast right now. Obviously, growth has been stronger, but there's the concern about the tariffs. What's the impact in the short run? Who knows? Chuck Schumer's out today saying that the continuing resolution that's being conjured up by Speaker Johnson and himself, that's going to go through March 14th, if I recall correctly. And so now you're talking about the first quarter of the year with no change in trajectory for federal spending and an interest rate that's 25 basis points lower than where it is today for that period of time. So growth probably supported in the first few months of 2025. That probably puts the unemployment rate on a similar trajectory as well. 4.4%, a little bit higher than where we are right now, but not by much. This is where the risk comes. It's in the inflation forecast. If I think they're going to do anything, they're going to bump this part up here. In acknowledgement of the fact that inflation has been stickier and the economy's been a little bit stronger. But does that change anything down here? Maybe this goes from 3.4 to 3.6, 3.7. They still give us a signal that there's 3 potential cuts coming. It feels like a lot of the hawkishness is already there, already anticipated.
Exactly.
I find summary of economic projection meetings to be very, very important for markets because they represent potential narrative turning points. The Fed can make an argument to change the rudder of policy because they now have evidence in hand to justify that shift in policy. But I don't think there's much of a shift here to look for, at least in the short run, because the reasons why they might want to shift their 2025 forecasts are still largely unknown for their impact, with potentially.
Which is why you go to 3.7 rather than pacing the market, which is what gives you that episodic opportunity for the markets to go, oh, we've gone too far. Buy the rumor, sell the fact.
But if the Fed gives us 3 cuts for next year, right? The current market pricing for next year
is 49 basis points.
let's see here. So we have one cut for December. We have a second cut coming in March. And then the final cut would come in September. So we're talking about two. I mean, there's a little bit more priced in, perhaps, going into it. It's two cuts for next year right now.
Right.
I think if the Fed were to give us guidance for three cuts tomorrow, you're going to see bonds break down again because the bond market's going to say, oh, you're giving us too many cuts. This is just like what happened in September. You shouldn't have started off with 50. And that probably hurts stocks up front, just like it did in September. The day of the Fed meeting itself on September 18th wasn't fantastic. But what you saw thereafter was bonds continue to break down and then stocks ultimately resolve themselves to the upside.
Big difference, though.
Mm-hmm.
Big difference from now in September. The markets were to the dovish side of Fed forecast in September. They're on the hawkish side now. So the adjustment would be in the opposite direction. The markets have done more of a hawkish adjustment than the Fed is probably going to endorse, whereas what happened in September was the other way around. The markets were looking for 5 cuts. And the Fed said, maybe 4. And that was deemed too much, with a 50 up front and another 50 to follow. So the table is set in reverse. Last time, it was the market that was saying you need to be more dovish. This time, the market is saying we've adjusted over and above the hawkishness that the Fed probably is going to endorse if they're as gradualist as they've been saying.
Dylan, do you think any of this matters at all for tomorrow, or are we just window dressing as we're in the quiet period ahead of the Fed meeting?
I mean, I just think the market wants to go higher at the end of the year for all of the reasons that we all know, and I feel like the Fed meeting is basically a foregone conclusion. I mean, and that's obviously a very public point of view. I'm not saying anything that's terribly innovative. The only question is, why would the market not go higher? And the only reason the market would not go higher would have to do with valuation, not because of the Federal Reserve. And to your point yesterday, valuation is one of the least reliable references for market action, full stop. So you're going into, everybody's going to start to go away after Friday. The year is going to be like Friday, basically it's over because next week is Christmas and New Year's and blah, blah, blah. And so I just don't see how the market doesn't drift higher here, period, regardless of what happens at the Federal Reserve tomorrow. And if anything, I think it's in the Federal Reserve's interests to be irrelevant. They don't want to be relevant to the market directly. They're going to do everything in their power, I think, to be a non-event.
It feels like they want to be a non-event. Ahead of time, though, stocks are certainly pulling back in. The Dow Jones falls more than 250 points today, which means nothing because it's the Dow Jones. But what does matter, it's a 9-day losing streak, which is the longest that it's had since 1978. Likewise, it's another day of negative breath for the S&P 500. That marks 12 trading days in a row. It's every single day thus far this month where we've had negative breath in the S&P 500. Courtesy of Ryan Detrick, friend of the show, Carson Research, we were exploring earlier what happens after you see a significant decline in breadth like this, because historically it doesn't happen that often. The last time we saw a stretch of it this long, at least, you have to go back to 1996 when you had 11 consecutive days. And a month later, the market was lower by 4.3%. But 3 months later, the market was higher by 3.2% in that instance. So ultimately, a short-term pullback didn't necessarily amount to a top. Overall, though, since 1950, we see that there are occurrences when you have at least 8 days or more of negative breadth. The average return for the market is 0.7%, higher 60.5% of the time 1 month out. 3 months later, on average, the market's higher by 2.2% of the time, higher 65.7% of the time. So on average, higher by 2.2%, 65.7% of the time. So at least in the short term, like, this breadth thing is an issue right now. It's clearly bothering some. We can look no further than the difference between, say, the Mag 7, which is up about 12.4% this month, versus the S&P and 493, which is down 3.13% this month. New ETF that was just launched a few weeks ago, back in October, which I suppose if you've wanted to own everything else in the market except for the S&P, except for the Mag 7, now you have a chance to do it in the X Mag ETF. But either way, though, that's really the state of this market right now. People are piling into the mega cap tech. They're moving out of the smaller cap names. They're moving out of the relative losers, so to speak. And it's all the companies that really did well under Trump's first term, plus the new premium of the first buddy trade. Dylan, can't believe we're calling it the first buddy trade, but I've seen now
it's one of the most epic maneuvers in history. The who even knew there was a first buddy trade to be had, but here we are.
I've seen actually a few people call it, saying, "Oh, we should have started first buddy capital," and just been long Tesla and crypto and yada yada yada. Tesla since the election, obviously having a crazy time here, but most people, I don't think, appreciate that its year-to-date gains have all come since Election Day. Tesla was flat year-to-date.
I mean, this is the most striking evidence of government corruption ever. Not since the health insurance companies rallied on Obamacare has there been such an obvious example of a corrupt government.
Why do you feel that way? Tesla now at 90 points.
I mean, why do I feel that way?
Since the election.
This suggestion that if you have a social relationship with the president, that your company should double in value implies that your company's value is not based on either the merit of your product or the quality of your logistics, customer service, or marginal value in your domain, but rather on the social proximity of your ownership to power, to the presidency, which is how it is in Kurdistan or Tehran or Kazakhstan or Russia or China. And the American argument is that proximity to the president is not a relevant consideration because we are a glorious, uncorrupted free market economy where the greatest innovators win. And if that was the case, why has the value of Tesla altered by whatever? How much is it up since the election? So I don't speak inappropriately.
How much is
Tesla?
Since the election?
Term is a lot.
90.8%.
I'm going to call that a double. So it's a double in enterprise value, which is about a few $100 billion or some obscene. I mean, this is not a small company. What was the market? What was this thing? What was the enterprise value the day before the election? Hundreds of billions. Huge. It's a huge company.
Yeah.
It's now worth $1.54 trillion market cap. So
it was worth $800 billion plus or minus.
Well, yeah. And let's be clear. This is what the markets are saying, right? The markets are trading as though the U.S. operates on this
Kurdistan
on this kind of basis. That is not to say that it is and that they're right.
Of course, but that is. But
where the
market was right about the health insurance companies when Obamacare claimed to be helping the people, but yet oddly the insurance companies were skyrocketing on the new health insurance reform, and now Tesla is skyrocketing on the new first buddy status of their largest shareholder and CEO. But your point stands. I've listened.
Well,
I would love for you to be right.
Good. I mean, we have the markets that respond this way. Were this the Turkish lira that were falling in response to bonkers monetary policy, the response might have been, ye dare not sell the lira or talk down the lira lest we jail you. So at least the response has been to let the markets semi-freely send their signal. So what this means then, in my mind, because I agree completely, this rally is seemingly not powered by any kind of fundamental change in Tesla's prospects, but more speculation that the road will be paved for them through official favor. If that turns out not to be the case, man, is this a juicy short. But I don't think you can jump in front of it here.
Tesla obviously is a big part of XLY, the consumer discretionary ETF. XLY is the leader today. Congratulations, XLY. You're up by 0.31%. That's about it on the upside, though. 23 of the 25 ETFs that I track here are red in today's session. The only other green one is IBB Biotech, which gets a little bit of a bump as we see the CEO come out, or the CEO of Pfizer come out and say that the Trump administration isn't banning vaccines anytime soon. But that's pretty broad weakness here over the course of the session, led lower by KRE, the banking ETF, which now here has seen 4 consecutive weeks of losses and slumping. This looks just like the Russell chart if we're going to be, straightforward about it. But
yes,
if it's the
little short
banks,
that could.
If it's the energy companies, OIH, for example, is sitting near its lows that we've seen going back to October and quite frankly starting to get onto the lows of the year, it feels like a lot of the things that are supposed to be, the Trump trade positive right now, regional banks, oil, drill baby drill, we're starting to see some weakness in these names. So, Dylan, is this any sign that the enthusiasm that the markets have had over the past few weeks is winding down, or are there just more exciting areas to invest in right now than regional banks and oil service companies?
Yeah, I mean, I think the way your tone when you ask the question answers the question. We're at a moment where the super glide is the thing. It's not just Tesla, right? You get this the magnificent, the Mag 7 are the star. The super glide is back. And it's off. Look at this thing. Come on. And it's obviously it's led by the Tesla's first buddy, corruption trade, followed quickly thereafter by the quantum chip and the Google quantum chip and Meta this and Apple that and blah blah blah. And so because basically the Trump presidency represents a policy takeover, or is perceived to represent, who knows what it really represents, but it's perceived to represent a policy takeover by the titans of Silicon Valley of the U.S. of the federal government. Silicon Valley has taken over the federal government. David Sachs, Peter Thiel, J.D. Vance is their guy, Trump this, crypto reserve is coming. And so for a long time, New York and the banks control Washington, D.C., or the real estate industry, or the oil companies, or the real estate companies control Washington, D.C., or big pharma control Washington, D.C. Well, the Trump presidency is perceived to be under the total control of the Silicon Valley oligarchs. And I think that's why you see all these statistics which show if you back the big Mag 7 out, or if you back the tech companies out, the breadth is very narrow. There's all this non-performance or relatively weak performance in these other major industries, oil, et cetera, regional banks, obviously. I have not made a lot of money betting against the obvious, whether it was quantitative easing in 2008 or the technology companies' takeover of the U.S. government.
If you I think take the sort of very, very skeptic view and say, okay, if the Bush administration was the oil administration and the Obama administration was the healthcare administration, and this now is going to be the Silicon Valley tech administration, and you sort of subsume that view. And there are some very interesting things that you then look at as opportunities, because what tech world doesn't want is mass deportations. What tech world doesn't want is tariffs that are uncomfortable. And so there's some very interesting clashing between sort of the Cantor Fitzgerald view of the world versus...
You're saying Howard Lutnick versus Peter Thiel.
Howard Lutnick versus Scott Bessent versus Peter Thiel versus Peter Navarro. There's a lot of
David
there
Sachs.
are a lot of conflicting threads there.
Mm-hmm.
And if ultimately the winner is let's say tech world, if what Tesla is telling us is that tech world ultimately prevails, if that's what the signal is, then bonds are probably much too low because reflation is probably not going to be as dramatic because the tariff risk and the mass deportation risk is probably not as great as advertised.
Why do you say the tech world doesn't want mass deportation?
Because they want labor, and a lot of Silicon Valley relies on importing talent.
Right, but they're not. It's not. My sense is that Silicon Valley's talent imports tend to be computer programmers and engineers from India or Asia who enter either on work visas or J1s or whatever. That it's not legal.
That's a whole universe that needs support.
It's not. Giant, but I know. But the deportations are targeting. I thought they were targeting more the
all of these
hotels, agriculture, hotels, the illegal.
Well, that's. I mean, I'm sitting here 30 minutes from Silicon Valley in San Francisco, the southern edge of San Francisco, the closest you could possibly get to Silicon Valley while being inside the city itself. There is a massive ecosystem around what makes tech tick. A massive, massive ecosystem. And that massive ecosystem needs to be somehow staffed so that the programmers can do their thing. And mass deportations would be tremendously disruptive.
You mentioned
certainly would be tremendously disruptive.
Sure, that for sure.
You mentioned something in bonds before about this. I just wanted to remind everyone because December is an odd month. If you're trading a product like a fixed income ETF that BlackRock holds or is the custodian for, like TLT or HYG, they have a second dividend date, ex-div date this month. They do 2 in December in their prospectus. I was meaning to bring this up. There is an ex-div date tomorrow. So if you're trading TLT, keep in mind that the one that was here in December 2nd, there's also one December 18th. It's an odd month. So just keep that in mind if you're trading TLT or HYG, for example. I've seen some people talk about it on Twitter. Figure it's worth raising here because that is tomorrow. Tariffs seem to be a big risk. I've seen a lot of people put out some of their year ahead notes. You know, what are the big risks to the economy in 2025? I have one in front of us right now that we could talk through. Capital Economics puts together their key risks in 2025. What could go wrong and right? Guys, they say risk number one is a global trade war. And it's not that Donald Trump and the U.S. will trigger a global trade war. It's that other countries are going to respond aggressively to the trade war that we instigate. Economists globally are effectively baking this in as a fait accompli. Like part of the base case scenario, ceteris paribus, all things held equal, the U.S. is going to be waging a trade war vis-a-vis tariffs against the world. And the only thing that we're now worrying about is who responds and how do they respond. They call this a medium risk, medium high impact event for the market for 2025. Dylan, there's a number of people out there in the world that are saying the tariffs are for posturing. It's a negotiating tool. It's nothing to really worry about. Including people that are going into the next administration. Are we conditioned from Trump term 1 to not listen to the boy who cried wolf, pay more attention to what he does rather than what he says he's going to do?
That's the question. You're saying, is Donald Trump credible on tariffs?
Is Donald Trump credible on tariffs to the extent that?
Yes.
Day one.
Absolutely. Yeah.
Is there a trade to put on day one? It's noon. He's sitting up there on the rotunda, on the Capitol. Joe Biden, Kamala Harris, sitting nearby, smiling, waving. What's the trade you're putting on before he becomes president of the United States to take advantage of those tariffs? Is there a trade?
I mean, sure there's a trade. For sure there's a trade. But again, it's sort of like I'm going to go Sosnoffian, and to say like, even if you knew exactly where the tariffs were going to go, I don't know. I'm not sure where you would go with that exactly, honestly. I mean, I guess you would go to a short. I mean, who's dependent on the internationals? Who's the most dependent on the international supply chain? Walmart, Nike, JP Morgan. I mean, tariffs are terrible for all of the multinationals. Yeah. I mean, and who benefits? Because my other thing is it's also like the Muslim ban. Remember the Muslim ban? He banned everybody with last time around, the craziness with the airports. My point is not. I think he's very credible to do the tariffs, and then I think they very quick. I think they're gone almost as. I think he does it, and then I think they're gone within a month because I think it's catastrophic for the American markets. So I guess to answer your question with my own analysis, short the S&P on tariff madness, and the fact that the market's way too frothy by the time January 20th rolls around.
Well, and the flip side of that, of course, is tariffs are essentially just a sales tax on imported goods, so that's inflationary. And if you wanted to not pick individual company names or try to get in front of a market that likes going higher for reasons it likes to come up with freshly on an almost daily basis, the flip side of that is just bet on reflation, which is of course what the markets have been doing now for 2 months. They've taken a little bit of a breather. We'll see if the Fed kind of refocuses their thinking. But as you start next year, then long dollar becomes another leg of an idea, and short bonds again becomes another leg of an idea. I think you might get bonds higher, you might get the dollar lower as a response to this FOMC, but the trend as it's developed since mid-September, that's undisturbed. That probably continues. That's probably a story for next year.
What do you say, Vecchio?
I think it's the scale. I think it's the scale. I think if we were to see something right off the bat, 20% tariff off right off the bat, blanket across the board, you're right. I'm with you. Short stocks. Throw away any pretenses. Forget the stats about 3 months return after 12 days of bad breath, or what the market does 6 months out after an AAII bull bear spread snaps back. If you get a blanket tariff, the markets are going to suffer. Earnings are going to take a hit on the nose. Structural inflation increases. At least the odds of it go up. Curiously enough, I think that every minute that goes by after Inauguration Day and the tariffs, at least the broad blanket tariffs, aren't announced, the odds of them getting implemented fall further. If you're going to do something like that, you don't really need to worry about being precise. It's a ham-fisted policy as is, so why unveil it in an elegant, crafted manner? Get into office, announce a tariff on national security grounds. If he doesn't do that, then it probably means they're trying to limit the impact of this, because his administration is staffed by a bunch of billionaires who are from Wall Street. These are financial market folks. Trump really had the penchant in term one for looking at the stock market as a gauge of the public's scorecard, report card, if you will, as to whether or not he was perceived as successful. And I don't think he's going to shake that again. So with more people from Wall Street in that cabinet, I think that's actually an instinct that's reinforced, Dylan. So while you say the tariffs come off as quickly as they go in, they would come off only because the market tells the administration that they have to come off. I wonder if there's a calculus there, though, right, Dylan? Because if the cost of, I could easily see a trade-off where down the line, inflation doesn't go away because of the tariffs are in place. But net, let's say you get higher national income and more jobs. Trump's going to say, yeah, I didn't bring down inflation like I promised, but guess what? You have more money now. So it offsets the cost of the goods that now cost more for you to buy. It just, that literally is going to be the key deciding factor for me. Day one. If the tariffs aren't in place by the time we go to sleep on Inauguration Day, they're probably going to be a lot more narrowly constructive than people fear. And I think that would be the signal to act and ignore the big bad wolf that would be the tariff threat, at least in the early part of the year. Is that insane, Ilya?
No, it's not insane at all. I think there is a lot of credence to that argument, because you already see, for example, meetings between the incoming administration and that of Mexico, the administration of Claudia Sheinbaum, and initially the opener being tariffs, 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 and then the rejoiner being, hey, all right, we can work this out, and subsequently things look like, oh, we're not going to have a trade war. Everybody calm down. We just saw that Canada's finance minister has quit. And that's in the wake of the conversations that the very beleaguered Trudeau administration has sort of dropped the ball on getting ready for a trade war, that they're not doing something as productive, perhaps, as what the Sheinbaum administration in Mexico is doing. Friedland, the outgoing finance minister, in her resignation, she absolutely eviscerated Trudeau. She published the resignation letter, and basically it said, you want to give people deficit spending giveaways instead of actually bolstering our fiscal position for this negotiation. That probably speeds up government change in Canada, but we can see where sort of the collective thought process is. It's to look at the tariffs as an opening bid to a negotiation that can then avoid the brunt, and that's how they're being interpreted. So if that's how they're being interpreted, then there's no reason why the U.S. administration is going to be, let us call it, absolutist doctrinaire. All they have to do is say, well, look, everybody was so afraid of what we were going to do, we dangled the tariffs and we got what we wanted. We have the art of the deal in the Oval Office, la-di-da. That's a really easy sell.
Right, but here's a different angle on this, just just for the pleasure of it, I suppose, but it could play out. Trump, by his behavior, his apparent behavior, love a good bamboo forest, by the way, some lovely ones just outside of Kyoto. But anyway, Trump, by his sort of predisposition, takes almost subconscious reflexive pleasure at belligerence to America's closest and most historical allies, meaning belligerent to Canada, belligerent to Mexico, belligerent to Western Europe. Just those, let's just use those three.
Sure.
Right? Because it's the shock value. Like, how can you be belligerent to Canada? How can you be belligerent to Western Europe? How can you be belligerent
this season of The Apprentice?
Yeah, it's like, if all like
we're gonna tell Canada what's what.
These are your closest friends in the world. I mean, it's one thing to be belligerent to Russia or to China or to whoever, but you're going to be belligerent to, Brussels or Mexico City or Toronto or Ottawa, whatever. But let's assume the answer is yes, and yes. America is going to become increasingly belligerent to its closest allies.
I mean, we saw this last time, sure.
Exactly. That's what I'm saying. So I'm not. And so what is there a world where we have going to Chris's suggestion of first buddy capital, where we're short Canada, short Mexico, and short Europe, just on the fact that all three of them are in the crosshairs for American belligerence, at least over the next 6 to 12 months.
I think to Chris's point, which I agree with, that is the obvious call that the markets have been baking in, and the reality may well be that while the belligerence is almost certainly coming, and in fact has already come.
Right, it's already here, obviously.
It's already here. That the markets have overpriced how much belligerence, how quickly it will come, and the extent to which it is long-lasting. So I don't think there's any doubt that there's belligerence. We're seeing it every day.
Right, but that goes to Chris's tariff question, which is, okay, will Trump follow through on his belligerence with policy?
Well, right, and I think the answer is yes, but I think the markets have already baked out such a level of belligerence that maybe what the adjustment to make now is to a belligerence that's less impactful.
So much for bottoming. Mexico is back in its downtrend from the highs that you have back in May. Canada, that rising wedge that we were talking about last week, giving way.
Yeah.
Looks like it's a big problem here. The Canadian dollar's been in the throes of a bit of an issue for itself, down another 0.5%, closing at its yearly low in today's
Not good
session.
news when your finance minister resigns right before she's supposed to give a budget update, like the week of.
Yeah, you almost forget because if you're not really a currency person and you really only focus on the dollar, you forget that there's like a certain number of rules that apply to these other currencies that aren't the world reserve currency. Like the market typically doesn't like when there's tumult with your Treasury Secretary or Finance Minister.
Yeah.
Granted,
when you're not the dollar, these things matter.
The U.S. has had a pretty good run in terms of Treasury Secretary stability over the past 8 years, right? Steve Mnuchin was
pretty incredible, actually. There's been churn in almost every other post.
Yeah, Mnuchin and Yellen, it's been 2 for the past 8 years.
Yeah,
that's pretty stable, all things considered. But elsewhere, like it's a real question. So the German government collapsed, the French government's fallen. Italy is really doing its best, although I see Meloni was talking more about how her hands are tied, how she can't really do more to help reform the economy because of the immigration issues over there.
I mean,
Dylan?
that's Prime Minister Meloni to you, good sir.
Georgia, her and I are in first name basis.
Oh,
I'll tell you later.
Okay.
So the Canadian dollar at 70.12.5 right now, Ilya, is this what we're really looking forward to now? We know that the Canadian dollar has been in focus. We know that that the Mexican peso has been in focus. We know that Mexican stocks have been in focus as a result of this trade war talk.
Mm-hmm.
But the market's already moved on these things.
Yes.
So what's the next market we should be looking to?
Well, and I think the median. So as ever, hat tip to the very insightful Marco Papich that wrote the great book Geopolitical Alpha, where he talked about the median voter phenomenon. That essentially the opinion of the median voter is ultimately where government policy goes, regardless of whether the people choose to elect right, left, whether in fact there's elections at all. That the opinion of the median voter ultimately reigns. And you see that in China, for example, which is not at all a place that votes, in abandoning zero COVID restrictions once that became unpalatable in a critical way for the population. You see it in the both left and right embrace of deglobalization and tariffs, whereas Republicans historically have been the free trading bunch. So you see it all over the place. And with that, I think you look at what the median voter wants in the U.S., and it's very clear what that is. And it's also very clear.
It's utterly stupid what the median voter wants, which is lower inflation but higher home prices and higher wages, because those things are
lower
highly
home prices.
Not for their own home.
Not for their own home, though.
Right, yeah. Well, that's the
magic.
thing. You can't, it's like, I want more home equity, but I want house prices to go down. And that is literally the mindset when you look at polls of the median voter. It's like,
That's right. That's right.
But keep in mind, folks, those
Yes.
are the people you're trading against. And that's why there's money to be made.
Well, that's right. And so you look at this and you say, well, what is the number one thing that the median voter doesn't want? More inflation. So
But they want stimulus checks. So
they do want stimulus checks, but what they don't want is for the price of eggs to go any higher. And that's the lowest hanging fruit. If the price of eggs starts to surge, or if going out and buying a meal, even at fast food restaurants, starts to get expensive because you've upended labor markets, median voter does not want this. And I think the government understands full well that the median voter doesn't want this. So
I mean, like the bigger issue there
that's
for me,
probably a moderating function. Probably means Canada is cheap, Mexico is cheap.
the bigger issue for me, Dylan, with like the median voter argument about what they want is that the financial literacy in America right now is so poor. And so when you look to polls of what policy outcomes people actually want, some of them are so conflicting. You can't have a broad drop in nationwide home prices, but you also want to see your own home price go up, unless you're not living on an island, right? You're not going to see a big decline in inflation, but you want to see that your own wages continue to go up, because if your wages are going up, it's probably due to a macro condition. Your company's doing well. Why is your company doing well? There's broad demand for its products and services. Why? Because it's servicing enough people within the economy. So I have a tough time squaring that away, right? Like how far do you go?
I think you have to look at the election outcome to square it away, and find that that one of the critical features of this election outcome, one of the critical ways in which we got to this election outcome, is the Republicans have built a whole new coalition, not their traditional coalition, and that much of this coalition favors lower inflation, lower home prices, and deregulation of pretty much every stripe, and a hard line on immigration to a point. But inflation seems to be the key. Affordability seems to be the key.
Sure.
Whether that be of groceries or of housing. Yeah. And so anything that smells like it's going to make that headline issue worse is not anything that this administration is going to stick with for very long.
Tariffs included. Guys, I think
tariffs very much.
Yeah, that's why I think the tariffs go away as quickly as they come. To that point.
Tariffs very much.
I think there will be tariffs, and then the tariffs will it'll be like that Prime Minister of England, whose name I forget, who lasted 3 weeks when she tanked the bond market.
Liz Truss.
That's it. I think Trump blasts a bunch of tariffs, the market pukes in his face, and the whole thing goes away, just like the Muslim ban.
Well, I'll point out something that,
and then the first buddy steps in and says, "I told you so." Sorry.
I'll point out something that the first buddy has had involvement in, turning on or not turning on Starlink satellites, and that's the war in Ukraine. That's perhaps a transition that's ham-fisted, but I think we got a clear sign in recent days that the war is coming to an end. We've had a theory here since the election that a few things would play out if we were moving towards an end of the war. One, the sanctions against Russia would have to come to an end, which means all the money locked up in Europe would move away from Europe. Why? Why would Russians leave the money on the continent at risk of being sanctioned again? They'd go to an international money laundering center, but not any money laundering center, one that they already have ties to, and that's where the UAE comes into play. We've posited that if the war was coming to an end, the UAE would start to see a breakout, and sure enough, the ETF is moving higher. Likewise, India, as a middleman for some of the oil purchases, would see additional, perhaps, weakness here, and whatever bounce that it sustained after the election is disappearing. Election day is here on our chart, and we are now below where we were on election day. So despite equities broadly rallying, India has not been able to do so. And perhaps moreover, if the U.S. is going to be moving away from NATO and European countries would be forced to fill the gap by either starting to step up their fiscal obligations or reducing spending elsewhere or changing taxes, yada, 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 it would mean a deteriorated fiscal stance for the continent. For many countries,
and especially for Poland, who's the greatest beneficiary of NATO.
And especially for Poland on the Eastern Front. E-poll here is closing at its second lowest level of the year at 21.23 right now. A lot of that's come in the past 2 days after a rebound at the end of November, beginning of December, granted, so the call wasn't looking so good then. But some of the pieces that you would think that would start to shift as we approach Trump's inauguration, as we start to hear about these negotiations between Zelensky and Putin and Trump, if the war is going to grind to a halt in January or February with the ceasefire, you'd expect to see weaker e-poll, weaker INDA, stronger UAE. So I don't know if there are things that we want to put on just yet in that 45-day in, 21-day out window, guys.
Mm-hmm.
But over the holidays here, coming into 2025, I think we should have a list of tickers and a playbook outline for where we want to be and have some, like, throwaway capital. I always keep a little spare pile of capital around for some crazy thematic ideas. And the thematic idea here would be the end of the war. And so what would that mean for banks that are holding frozen Russian assets? What would that mean for, is that good news for the German banking system, Dylan? Is that good news for German industry? What does it mean for BMW, right?
Probably good news for the euro.
Is that going to be good news for the euro? What does it mean for European equities? Do we want to own hedged or unhedged European equities? But the pieces are starting to come together, guys. And I think that's one of the major themes that we have to watch out for in the first quarter, is how to take advantage of that in some of these.
What do a bunch of tariffs do to all these, to the euro and the European equities?
Nothing positive.
Nothing good.
Nothing positive. I mean, there's
a talk of a European
tariffs
war,
on the books already.
Yeah,
the Biden administration shelved them, but not fully. They just kind of paused them.
Trump has intertwined the tariffs. See, listen, like when you go through the first administration, he doesn't really know as much. It's his first time being a real politician. He hires a bunch of people from the Republican establishment. Slowly over time, he replaces them with his folks. I think one of the things that he learned is that, for right or for wrong, I'm not advocating on behalf of these policies one way or the other, right? Just want to clear that up because I always get hate mail from people on both sides. It's so funny. People
That's
think
how you know you're doing it right.
Yeah, right. I literally get emails every few days like, you're a Republican, you're such a Democrat. It's like, okay. A lot of why some of the policies Trump put in place in the first term that didn't work out is because they did them on spurious grounds that didn't really have standing. This time around, if you notice, when he's talking about the tariffs and he's talking about fighting with, countries, he's tying together the issues of immigration and fentanyl as part of why it's necessary to put these tariffs on. He's actually giving pretense for the national security crisis so that these can go in unabated, implemented day one if you wanted to do so, right? Europe is not part of that conversation. I would challenge someone to find me any information about Trump saying that we need to put more tariffs on goods from the UK or goods from Germany or goods from Italy. It's been decidedly absent this go around. Whereas in 2016, 2017, there was talk of the trade war and how it'd be great for the UK because they can negotiate their own deal with the US now that they were outside of the EU post-Brexit. Either way, though, I can get wound up about this. The point is that I think that what he says he's going to do, he's going to be a lot more effective at doing should he want to do it. But that's why the swiftness or the velocity with which some of these actions occurring or not occurring is such a tell. So if you don't get your blanket tariffs on day one, it means they're going to be more narrowly defined. That's probably going to be a good thing for U.S. equities. Probably bad news for China. Probably bad news for Canada, for Mexico, short run. But then we have the conversation about ending the Russia war with Ukraine, at least a ceasefire there. It might mean territory being lost. Who knows? But the market's beginning to move like that's going to be the next big major geopolitical development worldwide. Because, Ilya, I'll give you the final word here. We're looking at a Syria that looks like it's potentially being split up. Israel seems to be claiming ground. Netanyahu visited in the south, but the net result is that the Iranian terror network that has caused so much volatility in the region, it's just simply non-existent right now.
Falling apart. It's falling apart. And
do we need to be worried about this anymore? At least in the short run?
I mean, we need to be looking at the price action and thinking about where that price action is relative to what's occurring, how long it takes for the market to figure out what's going on. Because what this does in humbling Iran is sets the stage for a deal to be made. And if there's one thing that the incoming U.S. administration likes to do, it's to make deals. Certainly the Abraham Accords were a long time coming before they did them, but they did them. They actually got them on paper. The relationship between Israel and the Gulf Arab states has been covertly friendly for decades, but it wasn't formal and on paper. that we have now a situation where Iran's network is falling apart and they feel enfeebled, maybe there's a grander bargain to strike. And if there is, then the geopolitical risk now imbued in this narrow oil range doesn't belong there. In which case, what we'd look for is a break of this triangle on the downside, and that would be the trade.
Dylan, we'll have to think about more 2025 themes tomorrow because overtime is now out of time for this Tuesday, December 17th. We'll be back, of course, same time, same place, 4 p.m. Eastern, 3 Central here on Tasty Live, right after first call, 4 p.m. Eastern, 3 Central. For Dylan Radigan in Milan, Ilya Spivak in San Francisco, I've been Chris Vecchio in New York. We'll see you soon. On the other side of this break, stay tuned. Tasty at Night continues. Ilya Spivak's up next with Macro Money. I'll be back in an hour with Victor Jones for The Price is Truth. Be sure to stick around. Stay here. See you soon.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? tastytrade. Make your move.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide. Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
I started trading around 2018, soon as I got out of college. Stumbled upon a couple of different YouTube videos and learned that way. Truth or Skepticism with Dylan Radigan was actually kind of what really caught me in the early stages, because Dylan was sort of the skeptic and like I was a skeptic as well. And Tom was able to sort of convince him, and that was kind of my favorite show from the beginning. The fundamental principle that present fear of future uncertainty is fundamentally overpriced. In other words, volatility and selling volatility is the key to getting a statistical advantage in financial markets, is the biggest takeaway. And that's kind of just the overarching principle I follow.
When you've got a futures contract that's in contango, what does that mean?
Futures, unlike stocks, have multiple prices appropriated to them. That's known as the forward curve. So when a futures forward curve is in contango, that means that the front month is trading cheaper than the corresponding futures back month. So you'd see that forward curve most likely looking like this in terms of prices.
And backwardation, what does that mean for futures contracts?
Backwardation is the opposite of contango. So where contango front month futures contracts are trading cheaper than the back months, backwardation is the opposite. So those front month futures contracts are trading richer than the corresponding back month contracts.
Regulation time may have expired, but the conversation is just getting started. This is Overtime, the post-market scrimmage for market junkies. Join Chris Vecchio, Ilya Spivak, and me, Dylan Radigan, as we analyze the X's and O's for everything from earnings to politics to macro events and more. Nothing's out of bounds on Overtime. We break down the news to provide you a playbook for your trades. Watch Overtime Monday through Thursday only on tastylive.
Got the need for speed? No problem. On Tasty Trade, adjusting your option positions is a right click away. Rolling just got quicker. Tasty Trade, make your move.
The fateful day is here. We are less than 24 hours away from the Federal Reserve's final policy announcement of the year, and it promises to be an interesting one. That's what we're going to figure out here on Macro Money. This is Ilya Spivak, head of Global Macro at Tasty Live. We are going to unpack what the Fed is expected to do and not to do and at this announcement, and then also get into which part of this is actually market moving, because it probably isn't the actual rate change that's on the menu. So what we'll do here is we will unpack what is expected. We will take a look at what it means, and then take a look at some of the benchmark assets, some of the critical assets that are likely to be impacted, what that means in practical terms, what the key levels are, what the trading opportunities might look like. So let's go down the list here, and first benchmark the outcome of the meeting itself, the policy change on the menu. The markets are overwhelmingly convinced that this meeting is going to give us another 25 basis point rate cut. That is, for all purposes here, a given when the probabilities are this high. Now, of course, nobody can tell the future with perfect clarity, but when the likelihood is tilted to this dramatic extent, the Fed is not in the business of rug pulling markets and creating untoward volatility. So if the market has talked themselves into a 95.4% probability implied in Fed funds futures that there's a 25 basis point cut here, it is overwhelmingly likely that that cut is coming. It also is the case that then there is no market moving potential, or almost no market moving potential, aside from some initial wiggling here and there, to the rate change itself, because it is already in the price. Fed funds futures are telling us the markets are already priced for the cut. Indeed, this is the essence of how volatility works. Volatility in response to economic outcomes happens when those outcomes are different from what the markets already have benchmarked in asset valuations, and therefore there is a reason for those valuations to change. There's reason for people to buy and sell things because they find themselves wrong-footed. That is not the likely outcome if the Fed delivers precisely what the markets are anticipating. And so from the rate change itself, we have virtually no vector by which that volatility occurs. But this is one of those big quarterly Fed announcements where there's much more on the menu than just the rate change. And there we turn to the update of the Fed's summary of economic projections. This is something that happens once a quarter, and the last time we got it with explosive effect was in September. What this did last time was instigate 2 months of a dramatic shift across the markets, and what this might do again is something similar. Now, when we say the markets, for the purposes of this conversation, we have to jettison the shorthand that quote-unquote the markets means stocks. Because the relationship between Fed policy odds and the stock market, it's been, let us say, varied and diverse over the course of this year, depending on context. But the relationship between what the Fed has done and interest rates, and thereby bonds and currencies, that has been very straightforward. When the Fed last updated this, that was, of course, when they kicked off their rate cut cycle in September. What we saw was the Fed say, here we are at rates that are average 5.3 and change, 5.33 to be specific. That's, of course, the middle point between the last and the peak level for Fed funds after the 2022-2023 rate hike cycle. That was the 5.5 to 5.25 range. And, of course, the midpoint there, 5.33. So when the Fed kicked off this rate cut cycle in September, what did they say? They said for 2024, the rate will be 4.4. If the rate is 5.3 and it will be 4.4, well, shock of shocks, that's 100 basis points in cuts. That's 4 rate cuts. The Fed delivered 50 basis points up front in September with 2 meetings left in the year. It isn't a stretch then to say November and December would be quarter point cuts apiece. And of course, the Fed endorsed this idea. So what we then see with this cut that we're about to get after a third cut in November, this would be the fourth. This would complete this forecast. The Fed will have delivered exactly as advertised. The larger question, and indeed you can see this in policymakers' own conviction levels, is what happens next year. Now, the Fed, again, in this September update, said we're going to go from 4.4 to 3.4 in 2025. That's another 1% or 100 basis points in cuts. If we look at the almost now mythical dot plot here, this is the Fed's vision of which policymakers or how many policymakers voted for what outcome, we can see there's lots of conviction in what there is to do in 2024 for the Fed. Much less so in what there is to do for next year. Lots more dispersed, as we can see. And what the markets have done since this meeting is shift to a much more hawkish setting for what comes next. Note, here is the curve that was there in September. Of course, we've had one rate cut since then. That was November's cut. Here is the curve where it was in November. You can barely see it in the little dots because it is almost identical to the current curve as of the start of this week. What you see is rates now by the end of next year are expected to be quite a bit higher. Almost a 100 basis point difference by November relative to what was there in September. The markets have made a significant hawkish shift in what they expect is coming next. They, of course, are still baking out rate cuts. We can see if we're currently at 463, discount that by 25 basis points for this cut that's incoming, and you end up with a path down by November to 3.9, let's call it 4%, give or take, and you're still looking at least 2 rate cuts. As a matter of fact, if we look at the way that this has evolved, we can see there's the start of the Fed rate cut cycle. This is right before that 50 basis point cut occurs right here. The market has a cumulative 230 odd basis points baked in for this year and next, of which 100 basis points happens this year. 75 of that has already occurred. 1 more is due. That leaves 130 basis points for next year. Over the course of the subsequent months, since mid-September through about mid-November, we went to 50 basis points essentially, even a little bit less, giving us 2 cuts as opposed to 5, which is what 130 basis points would imply. Now, what is it that got the markets looking at the Fed and going, there's no way you're going to do 100 basis points in cuts, your forecast is wrong? Well, take a look at what U.S. economic data was already doing going into September's announcement. Already by late August, U.S. economic data started to improve relative to forecasts. This is data from Citigroup, and what it shows in this very helpful index isn't so much whether the economy is getting better or worse, whether the data is getting better or worse. This is actually much more powerful, at least from a trading perspective. It tells you whether the data is getting better or getting worse relative to expectations. Because as we said at the top of our conversation here, it is deviation from forecasts that generates volatility. It's not good outcomes or bad outcomes per se if those outcomes are already priced in. So in late August onward, by the time the Fed actually makes its move, this is already meaningfully improving. And what that tells the markets is that the Fed is dumping stimulus. It is saying it is going to do, in their estimation, 200 basis points in rate cuts, with 50 up front and 150 spread over November, December of this year and all of next. And that they're going to do this when the economy is not decelerating, but seemingly performing better than anticipated, and increasingly so, at least until mid-November when the tune changes. And so what the markets reason is that, okay, well, the Fed's not going to do this much because as they start easing into a hot economy, they're going to bring inflation back up. And that, of course, will stop them in their tracks because they still want to get to 2% inflation. You see that in very clear terms here. Already by the time you start September, the market is starting to sniff out that the Fed might overshoot on the dovish signaling, because the bond market is starting to show you that inflation expectations that are priced into 5 and 10-year paper is starting to rise. This is derived by taking the difference between nominal 5 and 10-year U.S. Treasury bond yields and their TIPS, or their inflation-adjusted equivalents. That inflation adjustment, of course, is what ends up being these curves, these break-even rates. So what the bond market starts telling us already in early September, even before the Fed acts, is that inflation expectations are on the rise. When the Fed finally does act, that marks a bottom in bond yields. They go up across the curve, both the 2 and the 10 years. And the dollar goes up because, of course, higher yields make the dollar that much more attractive relative to other currencies. If you earn better yield owning the dollar relative to, let's say, the euro or the yen, then, and of course, especially the yen, which is a perennially low yielder, then you end up with a stronger dollar as demand goes to where the yield is. Since then, we can see from about mid-November, this has kind of started to idle. There was a bit of a pullback in the narrative. And as we've kicked off December, we've basically reset to where we were, where this move sort of found its exhaustion point. So we had about a 2-month adjustment, mid-September to mid-November, bit of a digestive pause, and now we're right back to where we started on the dollar, on the yield curve, on the 2s and 10s, and indeed on inflation expectations. So the market has spent all of this time, 3 months really, readjusting and then anchoring to a Fed that's going to have to walk some of its dovishness back with this week's update of the summary of economic projections and its forecasting. So that's where the market already is. They know, or they think they know, that this number right here is too low. And that what this number has to do is go down. And if you believe and take at face value what the markets have done here, the move from 130 to 50 is not quite a decline that's 3 times, but it's over double. So the outcome has been cut in half. We are expecting less than half of the rate cuts for next year, looking at what the markets think, than what the Fed actually projected, and indeed what the markets themselves had. So if the Fed were to pace markets here, and we sort of account for the idea that the Fed is not as sharp in its adjustments, then we might say, okay, well, the Fed is going to have to go from 4 cuts down to 2. Probably not going to go down to 1. That's probably more aggressive than they're willing to do. So let's say that this number goes from 3.4 to something like 3.9. And then you'd have 2 cuts rather than 4 in the outlook. And that would be baseline. That would be the Fed basically saying, okay, the markets have told us where to go, and that's where we're going to move. But the message that we've been receiving from the Fed has been one of, let us say, committed gradualism. This is from the minutes of the Fed's latest meeting in November. And what we find is that the Fed is both committed not to pre-commit, that is to say, they don't want to put themselves on dovish autopilot, so they've sort of tacitly approved the market's rethinking on where rates are going and said, yeah, okay, maybe we got a little overly dovish there. But at the same time, they're saying we're allergic to overreaction. We don't want to overshoot. We don't want to over-extrapolate from near-term developments. Take a look at what this says. And the FOMC minutes are always instructive in that they give you a sense for the degree of consensus around the various ideas. So we can see here many participants noted the volatility of recent economic data and highlighted the importance of focusing on underlying economic trends. That is, the Fed does not want to overreact. Almost all participants judged that though month-to-month movements would remain volatile, incoming data generally remained consistent with inflation returning sustainably to 2%. So the markets have worked themselves up around jumpy PPI data, let's say last week, to barely 50 basis points, but the Fed is saying, yeah, okay, if we thought it was 100 basis points last time, it's probably less. It's probably not half. Or at least we're not going to make that determination in one jump of a revision. So here we have an argument for gradualism. And of course, here we have the already well-established expectation of a large majority, quote unquote, of Fed officials that favored this 25 basis point cut in December. So already we know the Fed has taken this into account in its thinking, that this cut is a given, and that what the Fed then does in planning what it does next assumes that it occurs. What does that mean? Well, here's the move in bonds that has occurred in the wake of the Fed September announcement. Here's mid-September. This is what the Fed's forecast did. This is what 100 basis points in the Fed forecast for 20 to 25 meant for markets. They said, yeah, okay, no. And so yields went up, bonds went down. We see that there's been some digestion of this in the second half of November and into the first half of December, and we now find ourselves right where we started. Now, if the Fed comes out and says it'll be 3 cuts in the forecast and not 2, well, then the market is perhaps off sides. Perhaps it's made too much of a hawkish adjustment. And then what happens is the bonds bounce. Now, do the markets then overshoot? That will, of course, depend as things develop. But the risk seems to be that the markets have overstretched, that they've gone too far, that they're now off sides, and that the Fed's sobering effect is a lift on bonds. The other side of that is the same conclusion for the dollar. Again, here's mid-September. The dollar rapidly appreciates. This is against the euro as a kind of liquid standby for the overall direction of the dollar. This is its most liquid counterpart. And what we find is that we're struggling to keep going, that we're carving out something that's starting to look like perhaps a bottom. And if we extrapolate a breakout here, if 106.30 or so is the neckline on this consolidation, a close above it would imply back up to 108 or so, maybe a little bit over. So this could be the ingredients for a bounce in the euro. It could likewise be the fodder needed for another rise in gold. Now, we see here that last week, gold powered higher as we got news that China has resumed buying for their reserve account in November after pausing from April after a 18-month grabbing everything that's not nailed down kind of accumulation. But of course, then it seemed like the market started to pay attention to the Fed and to the rebound in yields. That would be this right here. And gold reset, came back down to that digestion area. Now, if bonds go up, yields fall, and the dollar weakens, the path of least resistance would be for this to extend back out. And if we can get north of the 2,700 figure or so here, well, then maybe there's a run at the highs at the 2,800 mark that follows. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am Also on with Chris for Futures Power Hour Mondays and Fridays. On with Victor Jones for The Price of Truth on Wednesdays. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com. And commenting sporadically on the platform formerly known as Twitter, as well as now on Blue Sky as well, at Ilya Spivak. If you're watching this on YouTube, like and subscribe, and check out our new live streaming of evening shows on YouTube. That's at the Tasty Live Trending channel. Make sure to see that as well. You can comment live as shows go. Thanks very much for joining. Macro Money's back tomorrow.
Hey Doc, your tips on diet and exercise have been illuminating. I'm sure busting my ass at the gym 5 days a week is going to be way quicker than just giving me the skinny shot.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
Batten down the hatches, everybody. He's going on the skinny bitch diet. He's going to be hangry.
From the smart mouths at Tasty Live.
Woof! The first half of this year's market has been giving the good guys the business.
It's certainly been back and forth for sure, Pete, and I'm getting whiplash over here.
With good mechanics, we can see Team Tasty stay strong in the second half.
Absolutely. Let's check out our starting lineup.
Nicky Bat, University of Kansas. Number 20, because that's how many underlines are in my portfolio.
Rick Welch, Illinois Institute of Technology. Number 23, because I'm trained 23 hours a day.
Dr. Data, Louisiana State University. Number, square root of 1 over 365, because that's the square root of time for 1 day, which is multiplied times the stock price, multiplied times the implied volatility, which gets you the projected stock price for 1 day.
I like the looks of that lineup.
Well, being mechanical is always better than just trying to run plays and see what sticks, Pete.
When you got skin in the game, you stay in the game.
That's right. Now get off the couch and get into the game.
Watch Tasty Trade.
We just ripped higher up to 50 points, and I just thought we would stay there, but...
The thing the market does best is it keeps you very humble.
You get paid a lot for being right, and you lose a lot for being wrong.
So give me, I don't know, a couple hours, and I will give you everything that you need to start trading options. See you inside.
Coming up on Bad Money with Jim Blamer. Blamer's hot stock tip of the day.
Trade ideas? Trade ideas? You're coming to me for trade ideas? I'll give you a trade idea. Trade me for tastytrade.com. Those guys are great. I love those guys.
Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Your crypto needs a wallet, and crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
Hello, everybody, and welcome back to Bad Taste. My name is Julia, and joined with me today is my regular co-host on Bad Trader, subbing for E. We got Luis in the house. Thank you so much for joining us. How are you doing?
Thank you for having me here. I'm doing great. How about you?
Dude, I'm vibing. I wish it was a green day, but that's okay. What are you gonna do? VST giving me grief. You had a couple of very cool trades on today, actually. How'd they wind up?
Yeah, it was all over the place today, but I actually ended up good, even though I actually sticked with my short on Tesla. Tesla, one moment it was down. Actually closed yesterday at 463. down today at 457 and ended up recovering as high as at 480. I don't know. Honestly, I feel it won't be so far-fetched if it touches 500. But it's recovering as of comparison to yesterday. It's not as high as yesterday after hours. After hours, it just spiked. So I'm in with my 25 shares today, Tesla. I'm going to be holding them. I still hold my quantum computing short, Julia. I think it was.
Well, you had a couple shorts on today.
Decision.
You had the qubit short, and then you had the nuke short, if I recall correctly.
I wasn't able to get filled on nuke. There wasn't enough shares available.
Man, you would have made some money too, because it only ended the day up 750% instead of the, what was it, 1300%? I think when we were streaming today.
Almost 1,200 when I tried to short it.
There we go, 1,200. So that would have been nice, but what are you gonna do? So
that
for any,
nice.
Oh, go ahead.
No, that would be very nice, but I still made a little bit of money on Meta, Axon, Palantir, well, recovering a little bit, and Reddit. I also closed my shares on Reddit that today pulled back nicely.
Oof, Maron. Oh, Meta. Here, let me close that real quick. Yeah, dude, you went a little ham today, didn't you? And so did we end up green? Did we end up on a scratch? Because the day was, I was looking at your daily P&L while we were streaming today, man. That was all over the place.
Yeah, it was all over the place. At one moment it was up 700 and down like only 100. But I ended up the day green in the middle of it. So it was a good day today. I'm excited for tomorrow. You have some stats for FOMC days. I always like to scalp a little bit when Jerome Powell, especially when he stops speaking, because you know me, I prefer to be a little bit shorter on side of the market. So I'm excited for tomorrow. I don't know about you, Julia. Will you be holding your Qs and your SPY shares?
Yeah, I'm still holding. On a red day like today, and it wasn't even that red, but on a day like today, when I've just like had a couple like kind of nice consecutive green days. These are pretty small trades, a lot of shares actually, don't tell Tom. But on days like today, I'm just kind of hoping, because we had such a red day in the market. It's actually over on Bad Trader. You can see it in the heat map. Like 75% of the stocks in the S&P were down today. The majority, I think actually consumer cyclical, I'm looking at the map now, was the only one that was actually green, the only sector that was actually green, at least looking at the S&P. So I'm kind of hoping for a little bit of reversal going into tomorrow. Plus with FOMC, it's kind of a crapshoot. I feel like it could go either way. But that being said, gold position, looking to take that off pretty soon. My IBIT shares are finally coming in. My little itty bitty bit of Bitcoin exposure, and not doing too shabby. Threw on a couple Russell trades today, or a couple Russell shares today, off of some of the interesting stats that you showed. Which was extremely interesting. I think we're going to get into some of them in a little bit. And then, yeah, my Qs, my VST trade has just been giving me grief ever since I put it on. I'm a great contrarian indicator in that sense, because right after I put it on a put spread, it decided to sell off 7%. And it's been kind of all over the place since then, but it's been a very strong performer all year. So I'm hoping, like, just in the couple days that I'm still going to keep holding this going into the holidays, that hopefully it perks up a little bit. But otherwise, yeah, you put on some trades today, sir.
Yeah. Today I went more short than usual, but I actually ended up covering most of them. For tomorrow, I'll be short the quantum computing, which I'm a little bit nervous because yesterday spiked 65%, today 50%, but it's up like 2,000% over the past 2 months. So I don't know. On the QU, yeah, that one.
This one, oh man! If I had bought in, it's still going. If I had bought in, I wanted to buy shares on this, and I didn't. This goofy thing. So this is quantum computing Inc. You went through some of the fundamentals, just because, now quantum computing and news around quantum computing, companies that are even tangentially related to anything quantum computing have really popped off ever since this news around Google's Willow chip kind of ignited some of these conversations. So I don't even know, was this Donuts who found this? One of our chatters found this ticker and is like, hey, check out Qubit. Which Qubit, by the way, which is a very fun ticker. Qubit is like a quantum bit. So like while regular bits are like ones and zeros, with electricity, quantum bits are quantum states that store information, kind of like the quantum version of a bit. Fun fact. So now we know why this ticker is amazing. And it actually continued to go up. I was really tempted to get in on this actually, and I didn't have a FOMO trade. And you took a short on this and you're still holding the short.
Yeah, I took a short around like $16 per share around it. Well, around 15.8, only 50 shares. So it's not a very expensive stock. So it's not that bad, honestly. No, I think a big deal actually showed nukes, but about QVT. what I was actually seeing is their revenue, less than 500,000 revenue over the past 12 months, has a market cap of around $1.4 billion. Crazy. And we discussed a lot of it also with MicroStrategy, how maybe unsustainable those numbers can be. You see MSTR just selling off after being added to the NASDAQ 100 on Friday, which I was surprised. I honestly thought it would be able to hold a little bit more of the rally. But also, for example, AppLovin as well, which they did not go out to the NASDAQ last week and just decided to actually sell off after a huge move to the upside.
You timed that short perfectly.
Yes.
That never happens. That's awesome.
Very rare to happen. It was a very risky trade because I decided to add more short that they were going to announce the new additions to the S&P 500. And people actually put AppLovin as a tier 1 contender. But I think they actually realized the mistake they did with SMCI because it's down 70% since it got added. It just got delisted from the NASDAQ 100. So they made a better decision at adding it was Workday, I think. So yes, it was a really good trade. Decided to sell off quite a bit that on extended hours on Friday and also last Monday. But yeah, quantum computing short, Tesla short. I believe I'm not the only one short here on Tesla, Julia. I think maybe even going for 500 doesn't look so far away right now after a huge recovery. But yeah, I'll keep my 25 share short on Tesla.
Dude, this is Bananarama's 104 IV rank. It literally broke the scale. This has been another FOMO trade that I haven't gotten in on. I think for the bet, because like the second I buy it or the second I go bullish, just right. You
should buy it, Julia, and I'll split the profits with you.
Yeah, maybe like I should get in on this so that your shorts will pay off. Because the second I buy it, it's gonna tank, right? But this has been really interesting to see. Just kind of a lot of news around more and more upgrades around this underlying around the future of self-driving vehicles. Really curious, honestly, to see how this where this goes within the next year, especially. I think next year is going to be very interesting, holding a whole lot. But that being said, like Tesla was lagging behind the Mag 7. It has been the least magnificent of the Mag 7 all year up until basically November, and finally starting to show a bit of growth. I think actually year to date,
80%, no?
Let's see, year to date, it's up 93%. Wow. That's crazy. It's up 150% in the last 6 months. In the last month, it's up 40%. So it is just being an absolute beast right now. This has to be, really honestly impressive. Speculative, it seems that way from my own, based on my opinion. But yeah, really, really explosive growth in this. And then the other one, this one Donuts did find the other one that you took your short off in this one, right? For nukes.
No, I wasn't able to get. There were no shares available to short.
Oh, that's right. There were no shares available to short.
It wasn't that expensive.
With this stock was crazy. Yeah, at the time of streaming, it was up like 1,200%. So around 11, around 12. Today, it was up 1,200%. And from the news that we were able to find, it had purchased, I believe, the holding company of one of the primary suppliers, because you're getting into shell shit now. It purchased majority stake in a holding company that had majority shares for a company that supplies Israel with critical components for the Iron Dome. That is my understanding. And it just completely popped off. So the drones, the nukes, all the things, that's quite the ticker. Nucleus Inc. ordinary shares. Nuke. So this was an interesting one. And you got it in short, but you were not able to get a fill on that trade. No fill.
Yeah, I only tried once. I took it as a signal because I was already very short for the day. So I decided to not try it again.
No, maybe that's a sign. Let's say it's a sign. Even though you would have made, actually, I think you would have broken even on it, wouldn't you? Trying to see what you got in. Would have maybe made like a little bit of money.
Yeah, it's a very, very cheap stock. So I would have entered maybe maximum 100 shares. That's the amount I actually tried.
Yeah. But yeah, so interesting day in the market, that is for sure. Hi, Flower Power. It's awesome to see you. Thank you for joining us. I wish my day was a little more red, but a little more green. Opposite of that, let's say Freudian slip, a little less red would be nice. But that's so much you can ask for. I'm looking forward to kind of like weaning down the portfolio a bit, going into the holidays, going into the new year, just to see whenever the Santa Claus rally might kick in, if not at all. But that being said, let's take a look real quick before we hop into slides. At where did the market indices go? The S&P, there we go. Pfizer actually having a bit of a green day, but it's still like a muted green day. Like the biggest mover in the S&P to the upside was Pfizer, and it was up 4.6%. And I feel like with some of the crazy rallies that we've seen in some of these stocks, that seems just very, a little bit muted compared to what we're sort of used to, I guess. Tesla, another one of these that's popping off. ENPH finally recovering a little bit, up 2.49%. Finally recovering a little bit. And then to the downside, I think the downside was much more interesting. CVS to the downside, Broadcom finally cooling off a little bit after some of the like just absolute shenanigans that we've had in this name for the past couple of days. This thing has just finally cooled down a little bit, but it's kind of like a drop in the bucket compared to like, this is crazy. The crazy pants.
Since their earnings, they actually added a little bit more than $300 billion in market cap. Tesla has added more than $700 billion in market cap in the last month. So just those numbers, I'm super impressed they're able to sustain them.
Mm-hmm.
That's why I actually decided to go a little bit short with the Quantum one, because I think it's something similar with DJT is able to sustain a little bit more, even though I would like to short it again. But yes, AVGO had a great return. Look at DJT, it's 38.
38. It really, while Tesla has been just to the moon, this one has kind of not really, not really gone anywhere, actually. It's just about flat since November, up a little bit. So really, the investor speculation is not impacting this one as much as I thought it would be, to be honest. And you were ballsy. You got in pretty much immediately after it got listed on the NASDAQ. You shorted it outright, and then those hard to borrow fees, if I recall correctly, kind of got you, right?
Yeah, those hard to borrow fees. I think it was like $11 per day that I was being charged. So I got a little bit bored, and it also got stalled for a month. Then decided to actually plunge. Added once again before the election, which suffered, but I was able to actually get out of it with a not that big loss, and I made a cover put on it. So that definitely helped me, because the premiums in DJT were crazy before the November 5th election. I remember the DJT was trading at 40, and the 80 call for November 15 was at $8. Crazy.
Oh man, dude, what a wacky, surprisingly liquid actually.
Yes.
Surprisingly liquid. What a wacky underlying. Man, this thing's goofy. But yeah, look at that. DJT, what else is moving today right before we hop into slides? Looks like CrowdStrike dipping a teeny bit, 3%. NRG, one of our sleeper builds actually, was in the top 10 of the S&P not even a couple months ago, and it has since dropped from that. Energy kind of reversing a little bit. GEV to the downside as well. UNH continuing to sell off Moderna. Yeah, what an interesting day. And then the S&P down 0.5%. It's been so interesting to see this, because I feel like maybe not today so much, but especially the last couple, starting last week, last couple days, I feel like we've seen certain companies have really significant volatility, crazy moves to the upside, crazy moves to the downside, and then the index doesn't really move much. Which has been, really interesting to see which companies have kind of had those spikes, and even major components of the S&P, major components of the NASDAQ, but then still having, kind of more subdued moves in the actual index, which is, just goes to show that diversification, which is neat. So yeah, I don't know, red day pour moi, but not the worst day in the world. And that being said, I think we have some slides. Do you want to get into it?
Yeah, Julia.
Sweet. Okay, let's pull up some slides, s'il vous plaît. So we got some market news that we're going to talk about, and then we're going to try to do a tradle, which I'm looking forward to because I have not looked at the tradle yet. But we do have an app. First things first, we made some sick updates this week. We're about to make another one, I think tomorrow, which is pretty cool. So if you want to go download it, we got points and badges and stream and chat, general tomfoolery. We would love to see you. You can find us in the App Store and the Google Play Store. And then as well, if you want to come throw your tradle guesses in chat, you can find us on Tasty Live's YouTube channel at Tasty Live Show. If you want to follow us on Twitter, Luis finds some really cool stuff and puts it on the Twitter. And that's at Bad Trader App is our handle. So, Luis, put some figures together. You've been rocking it with the figures today. The stuff that you showed during the stream today, I thought was super cool. So what do we got today?
Today, we got something especially for tomorrow as well for the FOMC, but also a little bit of the sell signal, which we discussed earlier. We did not see this graph. Their survey that they actually make it every single week, but this is a survey for fund managers. They see that cash the cash levels has actually dropped below 4% at 3.9% for all hedge funds, which this actually triggers a cash rule sell signal. This is actually the lowest level of cash hedge funds have had over the past 2 years, which is there's a lot of discussion said lately that there's a lot of liquidity also on the sidelines, a lot of cash. And like I said earlier, like it would be cool to see if there's like something that tracks it. But right now, hedge funds are totally invested into US equities. It's the highest also allocation, all-time high right now. It's another graph that we saw earlier. But right now, hedge funds are super bullish, and most of the money is actually invested on the stock market right now, which for Bank of America is actually a sell signal, and they call the market correction inevitable.
Inevitable. I am inevitable. The super cool chart. Yeah, BOFA has been really killing it with the charts as well, because I feel like a lot of the charts you pulled up were from BOFA today, right?
Yeah. I honestly really like their charts.
Which is super cool. I'm trying to find. There's one chart that was not included in the deck, which was the percentage of components in the S&P that outperformed the index. I'm trying to find it now so I can kind of throw it in, because that one I thought was super duper interesting. So we'll maybe touch on that in a second. But yeah, this is super cool. In terms of a sell signal,
I can send it to you.
Well, also like the S&P smashing through all-time highs and being up 30%. I think like bear mode's gotten activated pretty much, certainly in this office and across the sector. So, but really interesting to see some of the stats behind it. Super cool. Let's go on to the next slide.
The second one, this is from Bespoke Investment. I also really like their charts. But today they published this about the FOMC days, saying that actually Jerome Powell, which I was not aware, has seen the weakest S&P 500 performance during FOMC day. Tomorrow we're going to get at 2 p.m. Eastern his decision, and at 2:30 Eastern also his speech. But on average, you get a 10.5 basis points the full day of gain. And on the final hour, you see a drop of 20 basis points in the final hour. So I don't know if you've seen it. I honestly had never seen a chart like this before. But if I really like to trade FOMC days, and normally you see a big spike to the upside when the decision is made, when he starts talking. He normally speaks like for an hour. But when he stops talking, Julia, the market tends, I don't know why, this is just my opinion from where I've seen, to crash. And you see it here on the chart. I was very impressed with it. This is why normally it's a market trend that he took office since 2016. On FOMC days, a lot of traders, specifically, I could say this for the past 2 years, it's been really heavily traded from what I've seen, especially like on social media. A lot of people take advantage, especially when he starts talking. And I've been on Bad Trader with Chuku when he actually stops speaking, shorting the market. It's very fun. So let's see if tomorrow we see some weakness at the end of the hour, and we can get some good scalps tomorrow.
Super cool. Yeah, no, that doesn't tell a story. I don't know what does. Kind of like, I feel like, at least because we look at poly market all the time, it seems like the outcome is pretty well priced in. And I know that like when it came to really leading up to the first big cut that we had, it seemed like every FOMC announcement day there would be huge reactions in the markets, and then after the first couple cut announcements, it seemed like sort of pretty big reactions, and since then maybe been a little bit more muted. But this figure I find so interesting. I'm kind of like honestly not expecting that much of a shakeup tomorrow. I feel like it's pretty well priced in, but maybe I don't know. I've been real bad at like anticipating volatility around these days. So, but it's super interesting graphic, and I think we have one more as well.
Yeah, and the bad breath right now on the market.
I have bad breath too. It's okay.
The market today, the Dow Jones actually finished, I think it's 9th day straight of going down. Right, the value stocks ETF of the S&P 500, 11 consecutive days. But today the S&P had 12 straight sessions of negative breadth, more decliners than advancers, the second longest streak in almost 100 years. And right now, only 44.6% of the S&P 500 stocks are trading above its 50-day moving average. 64% of the stocks are trading above its 200-day moving average. So right now, this is something that people are actually starting to worry about a little bit. I think it's very interesting to see. Well, we saw the market down a little bit today, but the market breadth deteriorating so much. I don't know what that signals. We saw earlier on the Bad Trader stream that normally it tends to drop over the past year, almost 12% when things like that have happened. But we get so few data, or at least moments that this has happened. But yeah, Julia, today we saw another day. Let's see what happens tomorrow. But the breadth being so weak, that also made me become a little bit more bearish with the market today and took some more positions.
Yeah, really interesting. Again, another interesting graphic. It's pretty cool. Did a piece a while back. I think this would actually be a really interesting 8 a.m. piece to redo at some point. Like, does market concentration impact volatility, or rather, does higher levels of market concentration, as in like a larger amount of weighting going to a smaller number of components, does that have any, relationship with volatility? Does that make the index more volatile, less volatile? From what I have found, there have been extremely low volatility, very low volatility periods with very high concentration in the index, and vice versa. So, but I think it would be a really interesting study for a backtest, because I know that market breadth is something that, market concentration, something that's been kind of a point of conversation for over a year now, or maybe for even longer than that. And I did, let me see if I can pull this up real quick. I did find, it's not exactly, why do I have to, I would love to be able to paste. No, that's okay. Maybe I'll never be able to paste it. I'm going to try. Maybe I can just drop. Ooh, is that going to work? Okay, there we go. I was able to find a version. This is kind of similar to the one that you showed on stream today, but I found this really, really interesting. This is pretty similar to the one that you showed, right?
Yes. And
this is from Glenn Med Investment Management Fact Set, which is kind of cool. And basically, this is the percentage of components in the S&P that outperform the actual index. And we looked at something very similar. We did our own calculation sort of like last year, or rather at the beginning of this year. And we saw that about like 26% of the components in the S&P outperformed the actual index. Statistically, we'd expect that to be a little closer to 50-50. So I kind of just thought that, like, just looking at that one data point from that, study that we did a while back, looking at 1 year, I kind of thought like that was normal. It is not normal. And now we're at 37%, which is similar to what I calculated year to date for 2024. About 37% of the components in the S&P have outperformed the index. That's actually quite low. It's significantly below the average of 47. And you mentioned how it bears resemblance to 98, 99 is kind of when we were at similar levels with similar trends. These sort of historic lows. So I thought this data was really interesting. If you want to elaborate on that, feel free to.
Yeah, actually, right now it has dropped to 31%. So if you look at the only similar patterns on 1998, 27% outperform. 1999, same as exact as it right now, 31%. So this signals that just a few number of stocks are the ones actually pulling the market, as we also saw with the sectors. Out of the 11 sectors that make out the S&P 500, 5 of them are actually oversold. 3 of them are neutral, and 3 of them are overbought. Those 3 are the ones, communication services. Also, it's been technology, and I don't recall the third one. But those are the few sectors and a few stocks of those sectors pushing the market higher. As we've seen also the concentration of the MAX 7, actually it's been at its highest level, above 33%, which is also something that I think to consider about. But yeah, Julia, with a really weak market breadth, now you see the Dow Jones, I think it's something to pay attention, because 9 straight days of just continue selling off every single day. It's, I don't know, something, I don't want to be so pessimistic, but I've seen a lot of comments that they say and mention something will break. And I don't know if you've seen Reddit, Wall Street Bets, but people are saying we're going to get the Big Short 2.0 with Ryan Gosling and some of those crazy comments. But yes, this is amazing data that I really like to see.
It's really cool. And yeah, I was able to, so like when I did this calculation myself, part of the reason why this is hard is that you need the data of the S&P components going back that far. Like you need to know which like actually doing this back test is a little tricky. That's a fun challenge, I think, to try to do this myself, because I was able to do it last year. I can pull like, the fact sheet to get all the S&P components from like SPDR's website. But looking at it on a historical scale, this makes way more sense, because like from a statistical perspective, we would kind of assume that if you just randomly picked a stock from the S&P, your chances of outperforming the index should be pretty close to 50-50. And the data actually shows that in the long term. We're just in a very abnormal period where it seems like a lot of the index is actually getting propped up by a very small handful of companies that have just exploded. And what I think the conclusion that we came to on stream today, and in this way kind of shows it as well. When you look back to 98, 99, you can see that in the subsequent years, those were actually some of the best years for smaller cap companies, because, in 2001, 67% of the components outperformed the index, which, because it's a market cap weighted index, kind of means that, like, okay, those have to be the smaller companies, smaller caps, because they would make up a lesser weighting of the index. So if more of the components outperform the index, that kind of makes an interesting case for small caps. Taking all of the historical data with a grain of salt, actually. But I thought that was really interesting, and that made me want to buy a couple more Russell shares, which I think is cool.
Want to participate on the January rally that starts in mid-December that we saw early on the small caps that tend to perform.
Dude, I've been rooting for small caps forever now. Like, the Russell has lagged behind so hard. The S&P, the NASDAQ, and they're both up like 30-something% year to date. That's banana-ramas. And like the Russell has been, I mean, it's still up a lot actually, but comparatively, let's double check actually. I haven't checked on this in a minute. Year to date, it's up 15%, that's a lot, don't get me wrong. But compared to the other indices, yeah, I want, the rest of the economy to have a chance to catch up. That'd be cool. So I don't know, but really interesting data. I think this is super cool. I want to try to replicate this study. I just got to go get my hands on the component data, but really cool. Thank you for finding this.
You're welcome. Thank you, Julia.
Hell yeah. I think we're actually on time. Unfortunately, don't have time for a tradle. But if you guys want to do it, it's over on, I think it's like the OEC's website. So I'm going to do that after this, actually. But Luis, dude, thank you so much for joining me over here. Everybody in chat, thanks for joining us. Luis, is there anything that you want to say before we get out of here?
No, thank you so much for having me here, Julia, and we'll be seeing each other on Thursday.
Hell yeah. No, it's going to be a good time. So thank you guys, everybody, for joining us over in chat. It was awesome to see all y'all here. We'll catch you guys. Well, I'm going to be back on Tasty Live tomorrow at 8 a.m. with Tom and Tony. I can't wait for Tom to hate my segment. It's going to be a great time. And then Luis and I are going to be back on Thursday, actually, and hopefully we'll have some time for a tradle. So thank you guys, everybody, again for joining us. It was awesome to see everybody here. Good luck trading, and everybody stay green. Peace.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tastytrade. Make your move.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, 2 female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the Tasty Live core strategies.
How much does it cost you guys to do simultaneous hair flips?
Years of practice.
Everybody wanna be like me, yeah. I
Well, he's more public in his mentality.
I'm a believer. I believe that the world is good.
And I know that the world is not good. That questioning yourself and questioning yourself in dialogue with someone you respect is both pleasant and sometimes extremely insightful and useful sometimes.
Got the need for speed? No problem. On Tasty Trade, adjusting your option positions is a right click away. Rolling just got quicker. Tasty Trade, make your move.
Oh, yeah, it is Tuesday, December 17th. A little bit after 5 p.m. Central Time. The best time, you know what that means? It's time for Tasty Live's evening show, a little show called The Price of Truth, where we like to explore the incentives that govern our world. It is Tuesday, or so they say. You know what that means. We've got the one, the only, Mr. Christopher Vecchio. Chris, how you doing, my friend?
I am doing well, Mr. Jones. It's our final time together this year, so let's make it memorable.
Is it?
It is.
How do you know?
Well, because I'm off next Tuesday and I'm off the week after, so that would be the final 2 weeks of the year.
I wish you would have told me up front. If I would have known that, this would be an extravaganza, Chris. Now it's just going to be a regular run-of-the-mill show.
Yeah, I'm the kind of guy who retires from work and people don't even know it was my last day. So
are you a 2 weeks
still
notice
make
kind
it
of guy?
extravagant?
We can still make it extravagant, Victor.
I don't even know what that means. Are we doing this live? F it, we'll do it live. Matt, let's plan it on the fly. Make it extravagant. Last 10 minutes, let's say at 5:50, we're going to go into some extravaganza, Matt, and it's on you to dictate what that is.
Producers produce. Yeah, that's the job.
I got a feeling we're going to be disappointed.
I have high expectations and full faith in Matt.
This is the cold open, Christopher. I'm going to ask you one question only. Those drones over the East Coast, those military bases over the sweet, sweet state of New Jersey, domestic drones, international drones, or extraterrestrial?
Domestic drones.
Domestic. I don't think so. I think they're international.
Like the Vatican?
Are they? Do you think they're governmental domestic, or do you think they're like Jeff Bezos' NGO force and he's sort of flexing a muscle?
I think that the government needs to pass a continuing resolution to get various programs reauthorized in 3 days' time. And I think that colors a whole way of viewing this whole situation.
God damn, I didn't think about that. And they call me the conspiracy theorist. Somehow, that is the open for the show. It has nothing to do with what we're going to talk about. But welcome, all of you savages, on tastylive.com and Tasty Trade desktop, mobile and desktop applications. If you want to be part of the conversation, there's only one place to do it, and that's over on YouTube, on the YouTube stream. So hop in, start typing away, and we'll put your comments up on the screen. Chris, 6118 and a quarter, 22.2, 43, nearly 43,000. The Dow, I'm talking futures, my babies, and 2360. I know there was red on the screen today, but we're already at such stretched numbers. Is the fact that we got, down 0.2% in the NASDAQ, down a little bit in the Dow, down 1% in the Russell, and down 0.2% in the SPX. Is that anything to get spooked over, or is this a one-way train to Santa Claus upside?
Well, Santa Claus hasn't arrived yet. The very particular window with which that occurs is the final 3 days of the year and the first 2 of the new one. So for all the talking heads out there saying Santa Claus came early or Santa Claus hasn't come yet, well, this is not the Santa Claus rally window. And it seems like today is a day where you're just doing some paper shuffling ahead of the FOMC meeting tomorrow. There is a tendency where the markets go into kind of a pre-FOMC drift where in the 2 days leading up. If they go up on Monday, they go down on Tuesday. And if they go down on Monday, they're up on Tuesday. And really net, the first 2 trading days of the week are a wash. It's also an OPEX week. So how much stock do we put into some of these actions? I don't put much of any of them at all because the technical formations haven't broken. It is worth noting that volatility is perking up a little bit. Spot VIX moved above 15 today, and VIX 1D climbs over the course of the session as one would expect it to, given tomorrow's event risk. But it's not like it climbs to a huge level. We close out at 13.29 in the VIX 1D. And if we think about where we were, say, back in November 6th, we were talking about, 14.87. So the market is going into this Fed meeting with a little bit of a lower bar than it did last month. And in part because this is such a priced-in event. Maybe this is the all-clear signal, Victor. I know there hasn't been a lot of participation in the market recently. It's been all about the Mag 7, or really Mag 8 if you want to include Broadcom in there as well. But the Mag 7 are up 12.4% or so this month so far, while the S&P 493 are down by about 3.2%. So net this month, it's been a wash for the S&P 500. But the breadth has been that issue. So maybe the Fed gives us the green light and we could break the streak now of 12 days in a row, the entire month of December with negative breadth.
Well, value's been down 11 days in a row coming into today. I think this makes it 12. So you don't think, I would agree with you, but I'm contractually obligated to actually, let me piggyback onto your point. I don't think a rising VIX at this point is necessarily bearish. I think once we're at that 13 level, there's 2 reasons why you could get a rising VIX. One, because people want to continue this next leg and they want to hedge instead of minimize their exposure. That's one. And then 2 is you're going to buy upside utilizing derivatives versus potentially add to equity underlyings. And I know I'm oversimplifying here. I know the VIX is much more complicated and hedging is much more complicated than that, but I'm purposely oversimplifying. I think if you're at stretch levels and you don't have exposure, how are you going to get exposure? Well, you're probably not going to buy an expensive stock, but you want upside exposure. You might do that via derivatives. That increases the demand. If you already have exposure, you might look to protect yourself and continue to let this ride. So I think a rising VIX is not necessarily a signal or indication of fear, especially the fact that we're still sub 16 or below a long-term historical average. So that was my piggyback comment onto your comment on the VIX. And then the second one would be, do you think retail sales meant anything? I would agree with you that this is really positioning ahead of the FOMC, but you did get a noteworthy report this morning on retail sales. Did you interpret it any particular way, and do you think it mattered to the market at all?
Yes, I do think it mattered to the market. I think it's really interesting that over the past week, when we've seen Fed rate cut odds tick up closer to 100%, and they hit their apex yesterday or even this morning, just north of 99%, we've seen that Treasury yields are moving up higher as well. It was almost as if the market was telling us what it told us in September, which is to say that as the rate cut odds in the short term are going up, odds of reflation or inflation and growth expectations at the long end of the curve are also increasing. So you have to get compensated through higher yields for that to play out. And so today's retail sales report, it's hotter than expected, which the market interprets as a reason to take down Fed cut odds for tomorrow, only marginally, but from 99 to about 95%. And what do you see by the end of the day? The long end of the curve is poking its head above water. Ultras are your leader. ZB is in second place. Notes are barely down by 0.01%, bouncing far and away off the lows. And I would think then if you examine the relationship between the data releases and the Fed futures market and the Treasury curve, you're looking at a market that clearly cares about the perception if the Fed is getting too loose. When the market thinks the Fed is going to make a rate cut and loosen policy by too much, the bond market screams too quickly, reflation's here, we need higher yields because there's more inflation and growth coming. And when we've seen the opposite, when it looks like data is cooling down, okay, so the Fed is, we don't need to go through the vice versa. So tomorrow that sets up this interesting dynamic, right, where we now have going into this, if the Fed gives us a hawkish cut, where they cut rates, but then they tell us not so much maybe coming in the future. There's too much path uncertainty. The economy is too strong, coupled with whatever may come because of tariffs. That's probably good for the bond market, right? The Fed isn't going to do too much. They're going to reduce the risk probabilistically of that overheating scenario by not committing to doing too much. And that's ultimately a good thing. But if we get a big rate cut tomorrow and a heavy-handed dovish Fed, I would actually think that's bad for notes and bonds, because I think then the bond market goes, oh, here we go again, more reflation. The Fed's not getting the message. They don't need to do this much. Inflation's bumping back up in the night. So that's really where I stand. I think retail sales give you that insight today when you see that divergence between yields initially going down while cut odds were coming back in.
Yeah. I don't know what to think. I don't know what to think because I don't know how credible the bond market is going to think the Fed. In other words, the market has full control over the long end right now.
Yes.
So to me, to your point, if they cut, you lift it because you don't, or excuse me, if they signal dovish intent, they lift, which is what you said, I believe. You start to lift the long end because you don't believe that they're serious about fighting inflation, and you believe in the diminishing purchasing power of that capital. But I do think, to your point, they've already priced in what they expect out of them tomorrow. Like at one point we had they were going to cut in December, then they were going to hold in January, they were going to cut in March, which is kind of still what the aggregated probabilities say. And now they've sort of shifted all their second half of the year expectations. The expectations at one point was for a cut in June, so basically March, and then you go in June, and then maybe another one towards the end of the year, but was unsure about its timing. Now we've moved that one to in June all the way back to September, with the probability that you might get another one in December. So we've seen 3 cuts turn to 2.5 cuts, turn to 2 cuts, and a possible turn to one cut, and with the second cut much later in the year. In the last 2 weeks, man, since that CPI came in a bit warm, then the PPI came in super hot at 3%. It's like every piece of data we get is a reason for the market to keep taking out cuts, extend the cutting cycle of next year. And the equity market just apparently does not care. And I'm trying to figure out, Chris, should it care? Should it care that at one point the market was rallying because of 6 or 7 cut expectations within 2025 and 2024 and additional cuts of 2025? None of that's materialized. And we're getting more hawkish going into 2025. Why does the equity market not care?
I think a good portion of it comes down to the fact that if you're seeing higher rates, the market is at least of the mindset that it's going to see higher growth to compensate for those higher rates. That's really the only way that you can talk yourself into saying, well, rates going up isn't a problem for stocks. Because if rates are going up to reflect higher growth, if that growth is spilling over into improved corporate earnings, then not necessarily a problem for equities. And I think that's what the market's trying to figure out right now. Like, we're going to get higher rates. Yes, we know that. We've known that for the past few months. That's been the case since late September. But to what extent will the policies that are leading to higher rates also lead to higher growth? And I think the bond market probably has gone too far, and the stock market probably hasn't gone far enough. And what I mean by that is stocks probably are a little too excited and ignoring too much of the risk, and bonds are probably taking it a little too seriously. And, if the S&P was closer to like 6,000 and ZB was trading closer to like 120, I think that would be much more reasonable for both prices. And we'd be having much less of a conversation about overextension heading into 2025. But the reality is that both are kind of whistling past the graveyard to the most extreme interpretations of what the future may hold. So I do think that means going into next year, someone is going to be dramatically offsides. But for equity markets, I'm reminded of the fact, and we shared it yesterday in overtime, going back to 1950, if you look at PE ratios and how those companies, those shares performed over the next year, the correlation between forward 1-year returns on the S&P 500, whatever individual company you're looking at, and the PE ratio is negative 0.11. It's a statistically insignificant correlation. So I am reminded of a discussion you and I had a few weeks back after Trump was elected. Like, what was the best performing sector during Trump's first term? Information technology, tech. what has been the leader here on the other side of the election now consistently? Mag 7 names. The names that won during Trump's first term have risen to the top of the pile again. Not from the thematic, stereotypical, oh, he's for oil and he's for deregulation for banks, but like the actual winners of Trump's first term are now the ones who are pulling ahead in this market here as we inch closer to Inauguration Day. And quite frankly, that's probably the next big event on the calendar, because once we get through the Fed, you have a non-farm payrolls report on January 10th. It's a pretty clear sky.
Why do you think that is? Why do you think, do you think it's a reflexive memory of the marketplace that just says, when in doubt, Mag 7 it out? In other words, these companies have huge defensive positioning. They have sort of lobbyists behind them to defend their moat. They have cash positions that are gigantic, and the size of, with economic activity, the size of the rival GDP of other countries. And because there's an uncertainty here, more people are choosing to put their money in places where they're familiar versus where they're unfamiliar? Or do you think it has something to do with these tech titans paying the $1 million fee to Trump's inauguration fund, bending the knee, and then going to Mar-a-Lago and sitting down and having the dinner, which then gives investors reason to believe that perhaps their businesses are going to be safe and sound for the immediate future? I'm talking, of course, of Zuckerberg has done this. He paid the $1 million to Trump's inauguration fund, then got his Mar-a-Lago dinner. Jeff Bezos, if he hasn't already, he paid his $1 million and he's going out there to do his dinner and kiss the ring. Do you think this has anything to do with one or the other? It's the muscle memory? Is it them paying the fee to kiss the ring? Or is this a vision of the future where a lot of the growth is going to be concentrated in those 7 names into the next 9 to 12 months from the market's point of view, or a little bit of all three?
It's a bit of all three. The ring kissing. Trump pointed this out yesterday. He noted that during his first term, everyone was kind of like, oh, what are we going to do against this guy? Let's resist him. And I think the exact thing he said yesterday was, now everyone wants to be my friend. Mm-hmm. And it's because if you've been the first buddy, I can't believe I even were calling him that. If you're the first buddy, you've seen that your company's done quite well. Tesla's up 90% since Election Day. If you're a CEO and your job is to deliver shareholder returns, it's pretty clear that cozying up to the president of the United States may offer you a little bit of a comparative edge, because Trump is very much the kind of guy who sides with the last person that, the last person he spoke to, right? Like, guys talking about automation and modernizing the economy all through the campaign cycle. And then he talks to the head of the International Longshoremen Association and is now, as he said, he knows everything there is to know about automation, his exact words. Now he's against automating the ports, even though about half the dock workers in the United States don't actually work on the docks because they're collecting decades-old container fees that allow them to simply sit at home. They're basically like royalties. Victor, if you and I could go back in time, we would be born into international longshoremen families, because it's quite lucrative from just simply being in that blood lineage. But hey, that mobster, he's the one that Trump's kowtowing to. We're not going to automate the ports now because he got into Trump's ear. And I think actually that's Musk's policy and Musk's point of view. If Trump is the kind of person who takes seriously whoever's close to him, Musk is just going to sleep at Mar-a-Lago for the next 4 years. And Tesla's shareholders are going to be rewarded for it, because this is up 90% now, and everything in Musk world, if it's Dogecoin, if it's Fartcoin, if it's SpaceX with its valuation increase from $250 billion to $350 billion in the private market as it gets ready to IPO, it's a golden touch. And what CEO out there wouldn't want to say, hey, yeah, I figured out a way to get involved, and now our company is trading at a 25p instead of a 20. And that's great for everyone involved, because we're all wealthier and happier and fatter along the way. So, yeah, I think there's a reason why people are lining up. They've seen what the trout giveth, and it didn't take Musk that much, right? Tesla's market cap is up by $800 billion since the election, and he spent $277 million on lobbying efforts to get Trump elected. So not a bad return on your investment if you can get it.
Is this I'm going to take one aside here. Sure. Is this a reason why, I go back to this period of time just after Elon bought Twitter, and just after he started to become a little bit more I don't know, politically animated, and everybody and their mother said to him what he needed to do. And what he needed to do was cede control at Twitter. What he needed to do was stop talking about these political issues. What he needed to do was stop talking about, free speech and those types of values that he had, or at least wanted to articulate. Who knows? Maybe it was strategic from the outset, and it's not necessarily organic. But the point is, everyone said what he needed to do, and in the end, his path, while it took long and it was filled with volatility and variance for the shareholders, down to 175 or even below, maybe 150. But the fact that so much shareholder value has now been delivered in the end on a Trump victory, and given the fact that he's in a government agency, it's an unpaid role, and whatever.
It's not an agency.
Not an official agency, but you get what I'm saying.
This is like Arrested Development. It's like, oh, Mr. Manager, just manager. Like, not a government agency, no statutory authority, no congressional approval for anything right now. So it's just Victor. It's a McKinsey group, and I know I put it in those terms. I put it in those terms.
It's a commission.
It's a commission. It's a group of consultants telling.
Sure.
It's Sarbanes-Oxley. It's
why do you downplay it though? I feel like you downplay it, and I don't understand why. To me, this is like, I think, to me, this is the one agency I'm most excited about. I'm most excited. Okay. What do you want me to call it? Give me the name.
It's a
department. I'll call it a department.
No, it's not a department. Again, like it's being constructed as what's known as a blue ribbon commission, which is an outside group. It's an outside group to investigate an issue, and they basically just write up a report and make recommendations for the president to pass along to Congress. And so they can't act. They're going to have to convince members of Congress to pass spending laws, to change spending in order to get anything implemented.
They don't have to convince anybody. No, they don't. They have to convince one person. That commission was designed for one person and for one person only, and then that person has to go through the chain of command and convince Congress. Elon Musk and Vivek Ramaswamy they're going to construct it in a way that they're going to give it to him in a way that is politically feasible. Hey, this is your small, medium, and larges. They're going to give him 3 sort of portfolio sizes, and with 3 passive least resistance, and they're going to say this is what you can easily get done. These are larger projects that would have great amounts of efficiency, which might have a little bit less politically favorable. And then these are your big, hairy, effing things to do that you're going to need a ton of political capital to get pushed through. And I'm most excited about the things that come out of this commission. And I'm most excited because I do not believe that our government is set up efficiently. And I'm most interested because I don't have direct access to go through line item by line item and find the efficiencies that some of our greatest entrepreneurs, that the people whose wealth has been built on the idea that they are the best at getting people in a room and figuring out how to make them work most efficiently to maximize margin and maximize the end product, those people are going to bring those same talents to government agencies and to government as a whole. And we haven't, I don't know that we've done this in our history. And we have all this muscle memory, this bureaucratic sort of memory that's been built up over time. And what happens in old-ass corporations or in big corporations, if you go and you find some inefficiency and you ask somebody, if you've ever been new at a company, why do we do it this way? You'll get a bunch of people, if they've been there long enough, they'll explain to you, oh, we have to do it this way. And they'll give you a bunch of like legacy problems with legacy reasons because they're not looking at it with new eyes. And I think I'm most excited about this just for the report because I want to read it myself and I want to find the efficiencies, but I don't have the access. And I'm curious, you don't seem as excited.
No. Because they released the numbers. Why. They released numbers like their top line estimates are like we could identify immediately $900 billion of government waste that we can address, and like 600 of it is interest on debt. You can't not pay that. So
it's 1.2 trillion. If you want to cut out 1.2 trillion, you drop interest rates to 0 right now.
Okay,
there's 1.2 out of
which is inflationary, which is inflationary in the current environment, right? And so like they talk about, oh, we're going to privatize the USPS as a way to cut down government expense. USPS ran a $10 billion deficit last year. Its operating expenses were about $85 billion. Its operating income was about $75 billion. Okay. The U.S. federal government deficit last year was $6.75 trillion. Cutting out an agency that produces a $10 billion per year deficit doesn't do anything for the country's long-term fiscal stability. And all it does is screw over people in rural areas who aren't going to be able to get their mail on time. I don't know what it does. We're going to be paying Jeff Bezos to deliver all of our mail now, right? I mean, what does it do? What does it do to solve the problem of actually fixing spending? $10 billion deficit from the USPS is nothing in the sea. 0.18%. What do you expect? Victor, we shouldn't be parading around a 0.18% cut to the deficit as some accomplishment. That's not a victory. That's not draining the swamp. Come on. We got to be talking about 20% cuts if we want to have real substantive change. You want the Malay situation in Argentina, the chainsaw? No. Okay, but you want to get close to Malay?
You're not being realistic about what this commission is.
No, I'm realistic about it. It's nothing.
No, you're not.
It's not going to produce any substantive cuts. It's going to produce a lot of paperwork. It's going to produce a lot of nice things. Here's how we can reduce X, Y, Z.
No,
it's not going to go anywhere anytime soon.
You're mischaracterizing the commission because do you think the public is going to accept recommendations from Elon Musk and Vivek Ramaswamy to cut Social Security by 25%? Do you think they're going to accept recommendations from Vivek and Elon Musk to cut defense spending by 30%? Do you think they're going to so you know where the big line items in our budget come from, and you know it will be politically infeasible for them to talk about cutting these particular items. So instead, what they're doing is finding inefficiencies elsewhere, which are not going to be 5, 10, 15% items, but at the end of the day, they will create greater, more efficient government. And the bigger conversation around what we do with Social Security, what we do with defense spending, what we do with entitlements as a whole, that's a conversation for our elected representatives, not for a blue ribbon commission.
Absolutely. But like we have an agency that does this called the Government Accountability Office. And one of their jobs.
They're doing a terrific job, brother.
Well,
they're doing a terrific
job.
Have.
They've saved the country hundreds of billions of dollars a year. And what they're supposed to do, they're supposed to task produce a report for every agency. For every dollar we put into this federal agency, how much do we get out of it, right? Like for every dollar we invest in the IRS, how much money do we claw back in, tax evasion, for example? And with the GAO, for every dollar that we've invested in it, as independent auditors show, we get about $137 back in government waste.
Bro, these are all captured agencies putting out dog shit reports that pat themselves on the back and that grow the bureaucracy year over year.
Why are they captured? Because the people
the incentive structure.
Forget the incentive structure. If you think that they're captured, it's because the people
they get paid
in
by
charge,
the government. You wanted a commission
who's
that will
in charge
cut government
of
spending. What you do is you put together an unpaid commission who's not paid by government. It is a one-time commission, so there is no chance that the commission becomes entrenched, that they try to grow themselves, that they try to create additional power structure or path of power for themselves. This is the right way you structure a government commission.
Why not just put one of your guys in charge of the GAO then? Why not put Vivek or Elon in charge of GAO? I'm telling you, if they really. That's the point.
I think the incentive structure is better.
If they really wanted to do this, if they really wanted to do this the right way, they would take the people that they want. They'd put them in the positions of power. They wouldn't create new departments of government efficiency that aren't really departments, that are basic. I think it's an insult to Elon, is actually where I'm coming from. I would be pissed off.
That's how the media tried to do. What you're doing is you're giving me the line from New York Times. New York Times wrote this article. I know what you're going to say.
You know me though. If you know me personally.
I know what you're going to say.
If I would want to have more say than that. I would, because listen, if you're Musk, put all your stuff in a blind trust. SpaceX is a private company. Put Tesla in there. Go into the GAO
too busy.
With all
he
the action.
Want to do it.
They have the statutory authority to get it done. But I don't think it's going to be effective.
I think this
smart
is to be parroting MSNBC lines. I saw that. I saw that clip. And I saw that line on the New York Times.
Who's watching MSNBC these days?
Nobody.
85%. Come on.
Right, you're good.
You can't put that on me. So, don't you put that evil on me, Ricky Bobby.
That is a low-key hilarious scene. Like the fear the fact that he brings like that fear back from Green Mile, brings it into that scene. It's totally unplaced. It doesn't make sense. All right, now that we're done pissing off the audience, talking too much about some political bullshit. What do you do with Tesla? Let me ask you, what do you do with an incremental dollar if you own Tesla? What do you do with an incremental dollar if you don't own Tesla here? What would you do?
I think the trade is still on, as far as I'm concerned, until the trade is off, until Elon Musk's role in all this changes. Then there's really no reason to think it's going to stop. The tax credits that they're talking about getting rid of, and I think that headline passed through the newswire in the past day or two, again recently. As you've pointed out very astutely and corrected my thinking on this, it actually, because of Elon's role in all of this right now, or Tesla's role and size in the electric vehicle market, they've moved past the tipping point where the credits actually help them, and now they basically hurt them because they prop up competitors and new entrants into the market. And so getting rid of the tax credits helps solidify their position as the dominant monopolistic source or power, if you will, within the EV sector. And that's obviously great for Tesla shareholders. Having access to the person who has their hands on the economic levers of the country, the president, is obviously great for Tesla shareholders as well. But I think the bigger deal is that because Elon is now in this role as Trump whisperer, one of the things that we haven't done here in the United States that they're doing in other localities like China is just the full driving, FSD, full tilt. There's too many regulations right now. We talk about this being a big problem. They were trying, talk about how pathetic this is. They were trying to get permitting reform done in this continuing resolution, and they just couldn't get it done. And that's really the problem right now. We have too many layers on top of layers on top of layers. There's too much bureaucratic regulation that prevents us from making the kind of strides forward necessary. So the hope is that someone like Musk is whispering in Trump's ear. A lot of these regulatory obstacles that are in the way, they fall by the wayside. And so if the hurdles are falling, the barriers are falling for Tesla, but also the barriers to entry are now rising for everyone else because the tax credits are gone, right? It's like a really perfect, sweet kind of mix for a Tesla shareholder. So when do you want to get off the train? And the reality is that there is this George Soros notion of reflexivity here, kind of like what's happening in Bitcoin and MicroStrategy right now, which is to say that if you were an early person or someone who stuck with Tesla during the downturn, right? If you were down there through the drawdown to basically $100 a share and you wrote it out, guess what? Tesla's been the best performing stock in a year where stocks are having a banner year. It's up in the rafters with NVIDIA right now. And as an asset manager, that means people are going to be very, very happy with you. That in turn creates a demand for people to buy more Tesla, right? Because they now need to get on board with the big winner. It actually reinforces the Trump trade because everyone who was positioned in the Trump trade in September, October is now outperforming the rest of their peers who weren't positioned there into this final stretch of the year. And so now there's an incentive to be long Tesla, because if you're long Tesla, then you have access to the machinations of what's happening with Trump and what's happening economically with Trump. So until that changes, right, it's a bubble feeding a bubble, or at least in the George Soros, how do bubbles inflate? It's reflexive in nature. And I think we're kind of in the throes of that right now. Just like I think we're in the throes of that with MicroStrategy and the throes of that in Bitcoin to a certain extent. There's a lot of reflexivity in this market. So it's a very difficult market to try to say this is the top. And I will never, ever, ever be someone who tries to call a top. I'm not that kind of hero.
I've tried once or twice.
I'll call a bottom. Never call a top.
I've tried. This MicroStrategy thing.
Do you think the Tesla trade's over?
Do I think it's over? I'm not fading it. I'm long. I'm still a little long. I'm not fading it. For some reason, I feel like I actually shouldn't say this. What I should say is it's likely that if you're looking for a fade, it's approaching 500. And 500 is this big, nice round number, which it plays perfectly to round number bias, which says we're going one direction, we're going to hit this big round number, and that's where I see the potential for a reversal. So I think there's some part of me that probably can find its way slipping into that slipping into that world where 500 becomes a little bit of a fade. But I think what I don't get is I get the optimism. I get that the pathway has opened up for them to pursue FSD in a way that was clearly not open in the previous administration. And should that administration have been able to continue, I think that administration was going to look to build up competitors. So I had bought like Lucid and Rivian as sort of like these government plays that if the administration wins, or excuse me, if the previous administration won, that they were going to find ways to aid Lucid and Rivian and perhaps penalize Tesla. And I think that is now off the table. I think it's the exact opposite for the reasons that you mentioned. But what I don't get is, where does the new EV demand come from? You know, that's the thing nobody's talking about. Are people all of a sudden going to be buying more EVs next year or in the next 2 years, the next 3 years? I don't know that the answer to that is yes. In fact, you know, given the economic picture, I think the pool of their buyers is getting smaller. But if you hit FSD, then you only need one buyer, because that one buyer is like Hertz or Avis, and they're going to buy, you know, it's going to be one person who's going to buy up a bunch versus today it's 1-to-1. You get one buyer to one car. And in the FSD world, it will not be 1-to-1. So maybe the market's pulling that forward. And if that's the case, then no, I don't think we're done. But if this is just hope on a new administration, this has got to be getting long in the tooth here.
Hey, aren't the tariffs good too? Right? Tesla makes a bunch of their stuff here at home, and if you're worried about Chinese cars at, you know, below market prices flooding the market, Mexico taking a stronger stand at that, the chance that you have slippage in the EV price floor because of, you know, Chinese parts, Chinese vehicles coming into the country, that those odds are diminished now. So again, a lot of things that have just really cemented Tesla's market share. Now, are those things worth? Here's all right. Like, let's do a counterfactual kind of a thought analysis here. Let's say every theoretical policy that Trump may put into place because Elon Musk is whispering in his ear that would make Tesla's price go from where it was pre-election to where it is now. Let's say if Harris held every single one of those policies as well, ending the EV tax credit, trade war with Mexico, right? Stopping the Chinese imports, all of them, word for word.
Okay.
Would Tesla's share price still be at 479? And I would think the answer is no. I mean, I think there's a clear first buddy premium that's going on here. And that means the most important thing to watch out for if you're trading Tesla is Kalshi, because they have a market for when Elon Musk leaves the Doge Commission. I think if Elon Musk and Trump have a falling out, that's the most single detrimental thing to any Tesla shareholder right now. And quite frankly, until they have a falling out, there is no legitimate reason to try to call a top and short this thing. And on dips, the prudent thing to do is probably add in. But I think that's legitimate something that we have to consider right now. If it wasn't for the fact that he was the guiding hand monetarily that helped pave the path to Trump's return to the White House, even with all the same policies in place, I don't know if this would be trading at 479, 472 post-market, as we see here on the screen.
I would agree. That's a good way to look at it, I think. All right, let's keep cruising. One of the things I called out yesterday, the XLY was the outperformer. The discretionary income, discretionary spending was the outperformer yesterday. And I go, I wonder if that's the market betting on the retail sales outcome, betting the likelihood of a warm number. The second day in a row, and today was the only sector that was in positive territory. I don't know if that's true, and I'm smart for calling it out, or if it just happened to be that Tesla is in XLY in a pretty decent weighting, and I just happen to sound smart, but it had nothing to do with it. Tesla and Amazon just had pretty good days, and that's what carried XLY higher. What is your thinking about coming from like the post 2022 world, where high inflation was going to put pressure on the consumer and on consumer spending, and XLY's kind of been depressed, and it's starting to be the outperformer here. Lululemon is up big. Ulta's been up big. Chipotle. I mean, there's a bunch of names in this underlying sector have had these really big pops. And is this the early part of the resumption of the consumer discretionary, the consumer? Is this the first part of the market starting to say, all right, the consumer is not dead, and we're going to go a different direction with these underlying stocks?
There are some concern. I mean, I think this is a Tesla story. Let's just strip it back. They're 20-something% of the weighting of XLY. And on a day like today, when they're up 3.64% and XLY is up by 0.3, you can make the case that were it not for Tesla, the whole thing would be underwater.
Yeah.
I look at what's happening in PEZ, consumer cyclicals, which discretionary, cyclical, same thing, but PEZ doesn't have the Tesla like it has in XLY. I look at PEZ and I look at XLI, industrials. They're both getting slapped around here. Now, maybe this is a function of the fact that there's a finite amount of dollars in the system, right? If I'm invested in X and I want to buy Y, I might have to sell X to feed that purchase, right? How else am I going to finance it? It's one of the reasons why gold and silver may be struggling recently post-election, because why hold the shiny rock when you can, have your seed phrase and buy more crypto, because that's on fire right now. And we've seen that GLD flows have been going out the door the past several weeks, whereas IBIT inflows have been increasing. So maybe that's what's happening here. People are leaving PEZ and going into XOY. They want exposure to discretionaries or to a discretionary / cyclical ETF, but they want the ETF that has Tesla in it, not the one without it. Survivorship bias of sorts. So I don't really know what to make of that right now. The fact is, though, that breadth in this set of circumstances and the decline that we've seen throughout December, it's not necessarily a harbinger of bad things to come. Of course, people looked into this, and I was delighted to find out that someone who I always look to for these sorts of little obscure facts did indeed find this out. Ryan Detrick over at Carson Research. What happens to the S&P 500 a month, 3 months, 6 months, 12 months out after you see a stretch where you have at least 8 consecutive days or more of negative breadth in the market? We just hit 12 today. And going back to 1950, about 60% of the time that we have negative breadth, a month later, the S&P 500 is higher by an average of 0.7%. And 3 months later, it's higher 65% of the time by about 2.2% on average. So this is a really weird time for the market right now. The internals that I'm looking at when I look at the sector flows or ETF flows, they're not exactly matching the narrative that I have constructed in my head for why I want to be bullish. But the price action is still bullish, even if it's not for the reason I suspected. So I guess I want to chalk it up to a win. Better make money and be wrong as to why we're making money than be correct and be a loser, Victor.
Fair. I'm 100% correct, and over the last 2 weeks, I have not been a winner. But I will maintain that I am the one that's correct.
I was trying to poke fun at Ilya earlier, like gently ribbing, but like the Nasdaq's down more than 50% of the time over the past 7 trading sessions, and he's a bear and I'm a bull, and I've made more money than he has, even though stocks are down more than half the time since then, right? And
because they go down, we've been down like 1/3% when we're down, and when we're up 1.5%.
Right. It's like 2 or 3 steps forward, 1 steps back. And so, it doesn't matter that 2 of the past 3 days have been red. That one green day subsumed the others.
Mm-hmm. Let me ask you, here's the hard thing too. I don't know what I started this trade short one instrument, and I'm now short a different instrument. Here's what I mean. This whole shuffle at the NASDAQ with adding Palantir, which I'm super bulled up on, with adding MicroStrategy, MSTR, which I'm not necessarily bulled up on, but I am bulled up on Bitcoin. And I don't think the strategy that they're engaged, I think the strategy is really smart from their perspective. And then we've added Axon Enterprise as well, which I don't really follow. We've taken out Illumina, and SMCI and Moderna. So I started getting short deltas with one instrument, and by the end, I'm like, what the hell? I'm like, somehow we've gone from this super concentrated thing of just 6 or 7 names, and that's what I sort of wanted to bet against. Mm-hmm. Now all of a sudden, we've got defense contractor in there that I love, an instrument that's returning 2 times Bitcoin's performance. It's like, I don't want to be short that thing. You get what I'm saying? Like, somehow they found a way. They're discarding all their weak soldiers, and then they're bringing in these like monsters, like these just absolute mercenaries to the upside. And there's a part of me that thinks that's a contrarian signal. Then there's another part of me that goes, I don't really want to be betting against the NASDAQ the way they keep shuffling them up and putting all the monsters in here. What do you think about this? I don't want to call it reconstitution, but the shuffling up of the NASDAQ.
Yeah, so if you notice today, the day after that we find out SMCI is leaving, it has a pretty decent return. That's because since 2000, since 2010, in fact, the NASDAQ's been a unique creature. Since 2010, there have been 77 companies that have been added to the NASDAQ. There have been 72 removals net. Now, how does that work out? Some companies were taken off, put back in. So technically the removals is a little bit lower. Okay. 1 month later, after being added to the NASDAQ, since 2010, those 77 companies have averaged a return of 3.05%. 3 months later, 3.21%. 6 months later, 6.24% higher. By comparison, companies that have been removed from the NASDAQ since 2010, those 72 companies higher 1 month later by 6.76%, 3 months later 8.42%, and 6 months later an average return of 11%, nearly double the return of what you're seeing from the new additions. So being added to the NASDAQ, is that a great sign? No, quite frankly, it could be seen as a kiss of death for the average stock. Maybe it is for MicroStrategy, MSTR. I'm very curious as to why the market is treating this like a company that is offering a levered Bitcoin ETF, because they have overhead, they have costs that mean that when you look at the share price and you look at the Bitcoin that they hold and the net asset value of that Bitcoin, you're not buying a levered Bitcoin trade. You're buying like a half levered Bitcoin trade. I think like they own 0.45 Bitcoin in NAV relative to their share price at, last quote today. If you want to buy a doubled up Bitcoin ETF, you would buy something like BITX, but people aren't doing that. And MicroStrategy is outperforming BITX handily. So Victor, maybe they have figured out alchemy. Maybe the BTC yield is something legitimate. Maybe it's new math that we haven't figured out. Although I'm thinking of Robert Schiller and his metrics of eyeballs and castles in the sky that we recently, we think about the 2000 or 1999 tech bubble. I don't know, this whole inventing of metrics to substantiate valuations and share price performance, that has always been one of the telltale signs of a market moving into unsustainability territory. Now, does that mean that what Michael Saylor is doing is wrong? No. Because if the market's willing to give you debt converts at $600 share equivalents when you're trading at 400, you'd be committing a fiduciary irresponsibility by not taking that offer, right? Anytime, all the time. If the market wants to say, hey, yeah, we'll buy shares from you equivalent to $600, go for it. Go for it. That's your job as a CEO, return shareholder value. Now, again, will this work out? I have no idea. But would I short MicroStrategy here? Absolutely not. This is a crazy trade. I think this is crazier than GameStop, quite frankly. There's a really good blog post I shared on my Twitter feed last night. I'd encourage people to read about it. It's from Yet Another Value blog. Go check it out. It's worth the read if you're interested in the BTC yield conversation, because I'm trying to wrap my head around this new math, and apparently I'm not smart enough to do so.
So to a couple of points here.
But then again, I'm an MSNBC viewer, Victor. So don't trust what's going on up here.
Hey, it was either, when they accuse a comedian of stealing a joke, they say you either stole the joke or you're guilty of parallel thinking. So either you watched the segment or you read the New York Times article where they tried to position this as a demotion for Elon Musk and whatever, or you have the same parallel thinking as Joy Reid. So you take whichever one of those things is true. You take whichever one of those things is true, and that's the one I said.
The John Candy GIF where he's like, looking, pointing the gun around, and he finally just holds it to himself. Like that's where you put me in that.
So one, the indices are all bad traders. If you do, I looked at the same stat on the S&P. The S&P is the same exact thing. So whenever you add a constituent, it tends to be the local top for like the next year. And whenever you remove something, it tends to be the local bottom for the next year as well. So all these indices, I once called the S&P 500 the world's worst trader, the world's worst stock picker.
They did add SMCI earlier this year.
Yeah, exactly. To your point on MSTR, I've gone deep into the weeds on this thing. I've tried as much as my small pea brain will allow me to. And I'm trying to find the only thing I care about is where's the risk. And it seems like the risk is vol collapsing because everything's being funded by the gamma. Like the gamma in this whole thing is being funded by gamma traders. Mm-hmm. So when I break this thing apart, and I read, I think something similar a few days ago, a couple of pieces on the same exact topic, it seems like once vol collapses, that's when you can no longer do this because you're using vol to fund everything behind it. And once vol collapses, or if vol collapses, it seems like this whole trade goes away. What MicroStrategy does after that, I don't know. But once gamma traders can't fund this whole thing, once vol is not funding this whole thing, but what would be the world where vol on this instrument disappears? What would be the world and where vol on Bitcoin, the underlying asset, disappears? I can't see that world. So I don't know that we're anywhere close. All right, we got 5 minutes in, and because this is Chris Vecchio's The Price of Truth,
bring it on, Matt.
24, we have planned a terrific extravaganza. So for this, we're going to introduce our producer, Matt, who is now going to give you everything we've planned in a lot of hours. A lot of days of planning went into this. Go ahead, Matt. Show them the celebration.
I mean, I could start using the soundboard if you really want. Hey, I didn't say I planned anything, okay, man? I said we could do something extravagant. I said we could do something. You know, you can't just drop it on me like a project that I somehow forgot the day of, okay?
You could have put a diorama together in the last 45 minutes.
A picture, no. You know, you could have played a sound.
This isn't my show.
Anything.
Could have chat GPT'd it.
Chat GPT. Oh, I'm just kidding, Matt.
This isn't my show, man.
That's so true. All right. Instead, then, what we'll do is I'll give you 3 more questions on 3 different instruments, and we'll actually 4. We got 3 minutes, so let's see if you can do 4 inside of them. China, FXI, crude oil, gold, silver. We'll start with China. Your thoughts?
Oh, gosh, you know, this is another asset that falls into the bucket of being, you know, rationally irrational. And I mean by that is it's very difficult to short when you know that the PBOC and the Chinese government is really desperate right now to try to give the illusion that the economy is rebounding. And one way that they, you know, hold up the illusion, they keep the shadows dancing along the cave wall, is that they inflate asset prices. A number of times over the past few months, we've seen them pull the lever there. So I would suppose then the rationale would be on dips in FXI, if there's an opportunity to get long delta, look for it. And explicitly because of the convexivity here, I'd much prefer to have the long calls than short puts if we're going to express it that way. Now, with respect to what you just said about the others, let's go to silver first. Today, I put in an order. It was never filled. I'm going to put it in again literally right now after the show comes out. I may have to tinker with my execution because I want to be filled. But long the 33, short the 34 call spread. In SIH5, we're looking at I'm going out to 70 days to get filled. Why? Well, we were just near 33 a few days ago. We'll call it 5 days ago. So giving myself a 70-day window to get back to 33, I think that's a fairly good, good time frame to work with. But right now, the trade is constructed that it's basically a 5-to-1 with a 24% probability. Do I like a 24% chance at risking $800 to make $4,200? Yes, I do. I do like that a lot. And given that we're at the uptrend from the August, November, now December swing lows here, we're kind of at the neckline in SIH5 of what could be considered to be a head and shoulders pattern. The risk to reward of getting long at support is as low as it's been for me. so I want to get some upside exposure right now. Same thing for gold. I do have some long exposure in GCJ5, looking for a return back to the highs that we had in October this year. And then crude oil is an absolute mess. I mean, I suppose that you could do it like a long straddle right now because vol is low. If you want to do an Aristophane passion, you're doing it more as like the reverse iron fly, where you're capping off the wings. You know, you could sell the one standard deviation wings, both the call and the put there to amend the straddle. But is it really compelling? I think that's what we should be playing for, though. On a long enough timeline in crude, we are coiling right now like a spring. So let's play for the breakout.
So you're directionally neutral as to would you skew it one way or the other? In other words, do you think would you skew the probabilities or breakout to the upside or downside?
No, I wouldn't. I'm directionally agnostic completely in crude. I just think that we're going to move soon. And what really piques my interest, and maybe this changes, but I'm reminded of it in technical analysis when they talk about some of the characteristics of tops and bottoms being formed. Going into the top or bottom, volatility tends to contract. And as you start to make your way out of the top or bottom, right, that's when volatility starts to expand in anticipation of the breakout. So we just went through a period with crude where last Monday the IVR was negative 1.6, which on the platform, if you have a negative 1.6, it means that volatility in oil was 1.6% below its lowest reading over the past 52 weeks, to where we are now, where the volatility reading at IVR is 19.7. So there has been a volatility expansion here, even though we haven't left the range. The volatility is starting to expand now, so maybe it means a turn is about to develop. Which way? Who cares? As long as we get an expansion outside of this range, that's what I'd be playing for.
Wow, you just told a room full of vol sellers to go buy vol. You think
Yeah,
they're
I
gonna
did.
listen?
No, but I've been trying to get Sosnoff. I've been trying to get Sosnoff to listen all year about buying the S&P, and that hasn't worked. So I'm doing the Lord's work out here, Victor, trying to help people stay invested until S&P 10,000 and S&P 20,000. Yeah, but you know what? Mark Andreessen this week just pointed out that Google's Willow is
that
doing
guy's an idiot. Give me a break.
They're doing
He is such an
computations
idiot.
across parallel universes, Victor. Have you incorporated Earth 2's S&P 500's earnings into your estimates for next year? You haven't done that yet. So the bulls haven't even been started.
The multiverse? Is that what we're talking about right now?
Mark Andreessen said very seriously the other day that Willow's, the Google's quantum
it's a
computer's
theoretical
performance.
probability, sure. It confirmed the existence of multiverses. I know.
Yeah, and have you priced in the earnings profile of Earth 2?
I used to smoke weed when I was 25 years old and think about the multiverses. Okay, just because Mark
Now that
Andreessen
you're
had a couple of
45
gummies,
smoking.
had a couple of gummies, and now he played around with this super intelligent AI. He goes, it's like if there's one person who's weighing down whatever goodwill like Vivek and Elon are bringing to to that movement, Mark Andreessen is undoing it all. There's nothing about him that people are going to be like, yeah, he's authentic. He seems like he's out. He seems like he's doing the right thing.
He has a nice egg-shaped head.
There's nothing about that guy that the working people of this country are going to go, I don't know. I think he might have my best interest in mind. He should go lay low somewhere, talk to Elon on the phone, tell him what he wants, and stay out of the public's eye. Same with that other guy, Howard Lutnick. There's some guys who just like, you're a background player in this play, okay?
Unfortunately, Lutnick is now Commerce Secretary.
I know, but that's better than Treasury Secretary. Like when he went and did some interviews, and I'm like, God, how do you not know who's got the face for TV and who's got the face for radio? So you got to have a hard conversation. You got to sit people down. And I'm not, this isn't a physical appearance thing. What I'm saying is some people are inherently trustworthy and authentic to a voting mass public, and some people are not. And you got to be honest about that. There's no part of the voting public that wants to hear that's going to trust Mark Andreessen with the future. Same thing with David Sachs a little bit, who he put in charge of like the czar of AI. First of all, can I say this? I know I got to get you out of here. Why are we using the word czar? Why do we know where that word comes from? Why are we using the word border czar and the czar of AI and whatever? Do we not know the origins of these words? Why are we using it?
Solidarity, Victor. Solidarity.
Solidarity, comrade. All right, Chris Vecchio, the people want more from you. Can you tell them where they can go?
On Twitter or X at CVecchioFX. Of course, here on Tasty Live Monday through Friday. Futures Power Hour, 1 p.m. Eastern. Overtime, that's Monday through Thursday, 4 p.m. Eastern, 3 Central. The Price of Truth on Tuesdays, 6 p.m. Eastern with Victor. And also Let Me Explain on Tuesday mornings, 9:40 a.m. Eastern. If you are a Chicago Bears fan or a New York Jets fan, I gave Tom and Tony a nice little Christmas present this morning. And I destroyed my Aaron Rodgers jersey on air, so be sure to check that out. Otherwise, we'll see you tomorrow.
I will check it out. All right, man. Thanks, Chris Vecchio. Everybody in the chat, give him a round of applause and a like if you haven't already. And do my friend Matt in the control room a favor and tell him how much you appreciate his work.
I'm getting a lot of support in the chat, Victor.
They're here for you, not me, my friend. I'm pretty sure Matt's going to pull me into the some HR meeting. I'm going to get some Zoom meeting invite.
No, I'm just going to get the orchestra going if we go past 6:30. Don't worry.
Oh, that's a little inside baseball. What Matt is basically saying is, don't go over.
This is your suggestion, by the way.
I know it is.
This was your suggestion.
What Matt is saying is, if I go over the time limit, that he's going to start playing me off with the orchestra and just running the credits. He's threatened to do that in the past, by the way. He's threatened to just throw up the credits and end my show.
I have not threatened anything. This is the first time I'm bringing it up. You were the one that initially prompted this from the past.
All right. My memory's a little fuzzy, all right? I'm 38 years old. Give me a break, all right, my friend? All right, let's do this, everybody. We got about 20 minutes before they play us off and run the credits. So let's do this. Let's take a quick look. We did talk about bonds earlier today, but you know me. I'm a bond junkie, my good friends, and I don't think we did it enough justice. So I'm going to talk quickly about the shape and the look of the yield curve. The reason I'm doing this is because I think tomorrow is obviously with FOMC is going to be a big catalyst for the yield curve, and I think it'll start a new movement. Whether or not that movement is higher, and we continue that on each successive cut, we've gotten a yield curve that's moved higher and higher. Whether that's the case, I'm not sure, because it seems like we're going to get a very different discussion out of the Federal Reserve tomorrow. And this will be the last time I talk about this, because tomorrow going on, it'll be about the reaction. So the red line here again is the yield curve on the first cut. The green line is the yield curve on the second one. And tomorrow, and the blue line is as of today. Tomorrow we're going to get our third cut for the year. At least the probabilities say that we are. The current probabilities, as Chris mentioned before, 97.1% as of the close here today. So the greatest likelihood tomorrow they are going to cut by 25 basis points. And then the real question is, what do they put in the statement? For me, I don't really care about that statement, quite frankly. I care about this. This is the Federal Reserve Board's summary of economic projections. It is how they think about the future in terms of growth, unemployment, inflation, and their Fed fund policy path going out a couple of years and into the long run. So they're going to they put this piece of paper out once every 3 months. They're going to put a new one out. My thought process going into this is that they're likely going to leave growth alone. They're likely going to leave unemployment alone, but they might tick it up 1/10 on both 2025 and who knows about 2026. PCE, they likely have to true up and bring higher in 2025 at least. And the biggest question, the biggest movement on this piece of paper is going to be the Fed funds rate. In September, they had their path for the Fed funds rate getting down to 3.4% in 2025, which makes sense. I keep bringing this up, but I'll do it again. Because the 2-year, in effect, in many ways, is the market's either guesstimate or mandate to the Federal Reserve. You be the judge on which one that is, on where they're going to head. And in September, when they put this piece of paper out, the 2-year was at 3.5. So their projections came in and effectively just met wherever the 2-year was. So the Federal Reserve, their projections were in line with where the market was. So it was effectively blessing the market's pricing at the time. But now that 2-year is in a much different position. It's no longer at 3.5. We're at somewhere at 4.2, 4.22. So the likelihood in 2025 that this could change, I think, is high. And I'm guessing that they bring it up. I've said between a range of 3.9 and 4.2. And so it just depends on how hawkish or how dovish they want to be around that 4.0 number. So if they want to be more hawkish or dovish, they'll go 3.9. If they want to be a little bit more hawkish, they'll go 4.1. So I think that's the ballpark that you're in. And I think this is the biggest question mark in my mind. I have no idea what they want the market to believe, but that'll be the biggest question. We'll see how they answer it. And I think that the finished answer is going to be the catalyst to how you start pricing next year's curve. And what I mean by that is after this cut, the market moved higher. After this cut, we moved a bit higher, but not much. It seems like the market is growing comfortable in this sort of 10-year range at 440. So after this next cut, does the market move higher again? I'm not sure, because the market at this point, the Federal Reserve has the likelihood is that they say they're going to be much more cautious into 2025. And if the market believes them, it means you're going to see less cuts, which means there's less reason for the long end to lift. So in theory, after this cut, one might expect the curve to do the opposite of what it's been doing, which is to potentially go down. But the fact that you've still got 2 cuts priced into next year, it means maybe this is just, to Tom Sosnoff's point of view, a dead trade for all of 2025, that we settle into a range. Maybe you get some upward and downward movement for all intents and purposes. Whatever good they're doing by not cutting as often, they're going to undo by cutting twice in the next year, and perhaps that keeps us in a range for 2025. So my bets would be range bound to, in terms of yield, range bound to down, which means in bond price language, that's range bound to up. So I'm leaning a little bit long bonds here. I think they could press tomorrow, but that's probably the last press on yields. And maybe it's safe to take in some long deltas post the cut tomorrow. I also think it's an interesting sort of price level. We were in this congestion area. We broke out to the top. We're now at the bottom at 116. I think just on a retest of the range, it's an interesting price level. Where could I be wrong? I think I could be wrong. I could be wrong in that the market, we want to find, if they're really not going to get down to 3.4, if they're only going to get to 4, then theoretically that 10-year, it's not out of the realm of possibility to put that thing at 5% and then sit still. If you look at I've said this before, but you look at the long-term average difference between the 10 and the 2, the long-term average is about 100 basis points. Right now, we're only at 14 basis points or so. No. I think we're a little bit different. Yeah, 15 basis points. But the long-term average is 100 basis points. And if you apply that average to only getting the 2-year down to 4%, then that 10-year should be in the ballpark of 5. So where I could be wrong is this, that over time in 2025, it's a dead trade, but we just slowly work our way towards what would be a more normalized curve as they're moving the short end down. And so that when we're done, we end up in this normalized 4-5 range. 4 in the short end rates, 5 in the long end rates, uninverted yield curve with close to 100 basis points in between. That's where I could be wrong, that we continue this normalization. But I think a lot of things have to go right for that to happen. A lot of things have to go right. Keep moving here. EWY. I told you guys I've still got this bet on short-term bet on EWY. If you liked it yesterday, you're going to love it today. It got cheaper from 56 down to 53. So this thing is getting cheaper over the last 2 sessions. I think I'm going to have to double down, go a little bit more long here. But I don't have a ton of capital on this, and it's very short term. EWW was the second one. Again, the idea here is to find value outside of the concentrated risk of the Mag 7. If that's where you want to head, you don't need a 90-minute show to convince you to do it. Just go do it. But if you're looking for alternative places to find opportunity in areas that aren't highly concentrated or historically expensive, that's kind of what we look at. They're not necessarily going to pay off in a day or 2 days. We're looking for stuff that pays off asymmetrically and perhaps over time with a little bit less variance to capital, to the risk on capital. That's kind of what we do here. Same thing with FXI. I like what Chris said about FXI earlier today, that I think you have sort of a desperate government behind this. But I sort of think you could apply what he said to the Chinese CCP. You could apply that to everybody. You could apply that to the U.S. You could apply that to Europe, across Europe. That right at the moment where you have heightened social volatility, you have what seems like sensitivity in financial markets, and if you let that sensitivity break, you're gonna break social volatility wide open. So I think governments are in really tough positions, and for that reason, I think people are betting that they would rather take inflation than deflation, because deflation creates high levels of unemployment, and when you're already sort of in this weird place of social volatility, spiking unemployment to double digits it's going to be that spark. And I'm not sure that I think probably everybody wants to avoid that in this scenario. I might be reading the tea leaves wrong, but that's my read. And so you have worldwide governments that are going to lean towards the printer when push comes to shove. And I think that if that's your backdrop, if that's your worldview, then looking at a Bitcoin of 106,500 is not crazy. It is an anticipation of the reaction function of all of these fiscal government, these governments from a fiscal standpoint, from a monetary policy standpoint. I think it's pretty simple. Same thing with gold's a little bit different story, actually. Let me not put that in the same camp. There's a real yield aspect to this, but there is what seems to be a non-economic buyer, a price-insensitive buyer in China, buying this thing up again. So it looks like there's some support here at 2650. But me personally, on the risk and reward, I don't love the risk and reward from a trading standpoint. I don't love it at 26. I would much prefer to get a new entry or reestablish entry at like a 2500 to get more aggressive. So I'm long upside calls in GC, but it's very, very small, very, very tiny, and I've been more aggressive in adding things like the miners, new mining for instance, I think is an interesting buy here. Not saying it can't get cheaper, but if it does get cheaper, I think the metals will get cheaper with it. And if the metals get cheaper, then what I'll do is I'll get the opportunity to buy metals at my desired price and buy the miners at a cheaper price. So that's how I'm playing this thing. And right now, my strategy over the last 12 days has not been great. And so that what's happened over the last 11 days is value has just fallen off a cliff. And that's sort of where I'm hiding out. I'm hiding out in value, and I'm hiding out in sort of energy, nuclear, China, those types of instruments. There's a few other themes I've got that I'm blanking on right now, but it's just value in general for the last 11 days has gone down. And so I'm betting on the convergence of value and concentration. That's not happening. And so, sometimes you win, sometimes you lose, but that's That's the part that we're in. I loved the discussion on materials a couple shows ago. Opened my eyes a bit. I was not looking or ever looking at materials. Great opportunity in that sector, perhaps. But I think the one thing to note is it's likely these are all longer term outlooks. You'll get some short term optimism every now and again. People get excited about materials. They realize that oh shit. We need materials to build these batteries or to build these chips or to build these data centers. That at the end of the day, it's great to get built up on technology, but all that stuff comes from something. Lithium, cobalt, silver, nickel, platinum. We need stuff to build. This stuff is it's digital, but it comes from somewhere. And it seems like sometimes we forget that. And then we play a little bit of a catch-up trade. We're going to take it out about 10 minutes early, just for some logistical things on my end. But I want to open it up. If there's any additional questions, I'll grab some before we get out of here, but there hasn't been a ton. You guys have been active, but not with a ton of questions today, which makes sense because we have a guest. Roaring Kitty behind MSTR. All right. Yeah, I gotta go finish a solar system with my kid before school. Put the finishing touches on this badass styrofoam rotating solar system we built from scratch. No kits over here in the Jones household, okay? No kits. We go to the craft store and then we go to the old man hardware store to find those, a 12 volt DC motor. That's how we're doing it over here. Anyways, do me a favor, hit the like button on your way out the door, subscribe to the channel if you haven't already, leave us a comment if for whatever reason they've opened up the comments. If not, I'm sorry. Just hit me up on Twitter at Victor Jones. The Owen Jones is 0 because I like to be difficult. For our good friend and one of the best producers, Matt Walsh.
Hey,
as well
Welsh.
as
Welsh.
I even messed that up. By the way, I shouldn't have even mentioned your last. I shouldn't even doxed you on this. That was the mistake. For everybody working behind the scenes. For everybody working hard behind the scenes, and I promise you, this group, Tasty has hands down one of the best groups working behind the scenes in production I've ever had the pleasure of working for. So whenever you can, shout them out or send Tom a note and tell him how great work these guys are doing, especially around the holidays, so they get those big, fat Christmas bonuses. And so for them, for Chris Vecchio, I've been Victor Jones. I'll see you back here tomorrow, same time, same place, same great network, only on Tasty Live. Until then, peace.